Accounting is the process of capturing, summarizing, evaluating, and reporting financial data about a company. Accounting dates back to ancient civilization despite the fact that it appears to be the brainchild of modern financial environment. This emphasizes the significance of accounting and its role in human life throughout the millennium. Furthermore, accounting's relevance or value extend beyond the technical aspect of corporate operation. Its essence pervades our daily lives and underpin a wide range of mundane tasks such as filing tax returns and keeping track of transactions. This course will teach you some basic accounting words as well as accounting concepts such as dual entry, matching, and separate entity, as well as financial statements specified such as balance sheet, income statement, and cash flow statement. Finally, the course will show you how an accounting cycle works step by step. So if you feel the need to dig deeper and know more about it, sit tight as we are going to bring you all the information you need right on your screens. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions and I will respond to your comments. Now, very quickly, let me give you a brief idea about the agenda of today's course. In today's course, we are going to learn what is accounting, accounting concepts, accounting cycle, bookkeeping, management accounting, and financial accounting.
Let's start off by knowing what is accounting. So the first thought that comes to our mind when we hear the word accounting is something related to money and certain transactions involved, right? So the way of recording financial transactions related to an individual or business is called accounting. So it is basically logging certain expenses that have been incurred or revenue that has been generated. So now accounting process involves three major phases. The first one is recording, second is reporting, and the third one is analyzing those transactions for various stakeholders and regulators involved. So it can be internal stakeholders like the board of directors or external stakeholders like general public who wants to invest their money in the company, or regulators like SEBI, Securities and Exchange Board of India, or Tax Department. They would want to know that what are the financial transactions happening in your company. Now, second question that comes to our mind is, what is the need of accounting? Now, for an individual, it could be knowing about the certain expenses they have incurred over the past month or the past year, and also in what all categories their expense was. Was it in food, travel, shopping, etc.? Also, for a business, it could be knowing what are the best selling products of the company or how much cost they have incurred while producing those products. Also, they would want to know how much budget they spent in, let's say, marketing. So for all these questions, we would need a certain set of rules and procedures in which different numbers are set up. So this way in which all these numbers are summarized together is called accounting. And also the third question that comes to mind is, what are the benefits of accounting? Now, accounting would be used to develop a more efficient way of utilizing the money, which is also called cost control, and also to make very well informed decisions and thoughtful decisions for the company's future. You will also gain an understanding of how your competitors are doing by seeing those financial statements or accounting statements. Therefore, it becomes really important to learn accounting so that we can grow our business exponentially. Next, we'll talk about the types of accounting. Now, there are primarily 5 types of accounting. So we'll go through each one of them one by one. The first one is financial accounting. Now, financial accounting deals with the summarization and recording of various transactions into building 3 major statements. The first one is balance sheet, second is income statement, and the third one is cash flow statement. Now, these statements are readily available in public domain because it is both for the internal stakeholders and external stakeholders of the company. Next is management accounting. Now, this deals in identification, analysis, measurement, and interpretation of money related transactions. The point to be noted here is that management accounting is only for the internal top management of the company, and no information is available outside the company. The third type of accounting is tax accounting. Now, tax accounting involves the calculation of various taxes that the corporate has to give. Now, this type of accounting deals in the tax payments and tax returns of a company. So, it involves maintenance of GST records, paying of corporate taxes, etc. And also, this type of accounting is very important for individuals like you and me. So it involves filling of income tax returns, declaration of your investments, whether you have any capital gains involved or not. The next type of accounting is credit accounting. Now, credit accounting deals in the liability section of the company. Now, liabilities can be any. It can be a loan from a company, a loan from an individual, an organization outside the company, or even the mortgage that the company is bearing. Now, these type of liabilities have to be accounted and it comes under credit accounting. The last type of accounting is cost accounting. Now, cost accounting is a subset of management accounting, which deals primarily in the cost side of the company. So, the cost can be cost of production, cost of operation, and other miscellaneous variable costs. Next, we move on to bookkeeping. Now, bookkeeping is a very common term used in the accounting world. It is a systematically noting down of various transactions that are happening in a company on a day to day basis. Let me explain you this with an example. Let's say that you are an owner of a phone manufacturing company and would want to know what are the total profits that are earned. Now, in order to know the profits, you need to know what are the costs that has been incurred in making that particular phone. So let's run through the steps of it. The first would be design. The design team would design a particular phone. Then there would be material cost like the cost of casing, the cost of screen, the cost of various sensors and cameras, and also certain things would be procured by third party vendors like let's say chipset or batteries. So these all would be the primary cost of a phone. On the top of it would be secondary costs like electricity bills, supply chain and logistic cost, and various other costs. So after this, you would be marketing the product. Then you would incur a marketing cost and then you would sell the product. Now, the revenue that would be generated after selling the product minus your cost incurred would give you the profit remaining. Now, all these costs have to be noted down step by step in a systematic manner so that later you could go back and see what are the costs that were incurred. Now, the process of systematically noting down is bookkeeping. Now, what are the benefits of bookkeeping? So, bookkeeping provides an accurate picture of how well the company is doing, whether the company is in profit or is in loss. That would be understood when we do bookkeeping. Next would be it helps detect any fraud or irregularities in the transaction. So there can be times when certain things have been missed by a memory. So we can find what that is. We can detect frauds. We can detect what are the errors in certain transactions. The third one would be tracking inflows and outflows. So it means what are the cash that has come in from selling the product and what are the costs that were involved in making that particular product. So how much cash is available and how much cash has gone out of the company. Now, bookkeeping in itself is a long and a tedious task to do. And to make sure everything goes perfectly in the most efficient manner, this is divided into two sections. One is record keeping system, and the second one is tracking the transactions. Now, in order to make that system, there should be some terms and terminologies that are commonly known to everyone, like revenue, assets, and so on. So, we'll know about that in the coming videos. And the second part is to track these transactions. Now, the transactions can be a lot of different types. It can be complex transactions. It can be a very straightforward, a one-on-one exchange of money transaction. So to know all those transactions, you need to know what are the types of basically tracking those transactions. So we'll know that coming forward. So let's get started. The first phase that we'll be talking about is record keeping system. Now, before moving on, let me ask you this question. Can a profit of a company be greater than its revenue? We'll find the answer of it at the end of this module. So first off, record keeping system. So in order to develop any system, there should be some common terms and terminologies that should be widely accepted. For example, the head of a governing body of the country would be the prime minister, while the head of any government of a state would be chief minister. Now, these both terms are commonly accepted, and both you and I know what they are. Now, similarly, in the accounting world, we have some terms and terminologies that are commonly accepted, like revenue, liability, asset, expense, equity. So we'll know each one of them going forward. The first one is revenue. Now, the amount generated by the company from its core operations by selling a product or a service in a given period of time is called a revenue. Now, let's say that you are selling samosas. So each samosa is of 20 rupees. Now, 20 rupees, the selling price would be your revenue, right? So the point to be noted here is that the revenue is not equals to profit or loss of a company. It is just the selling price of the company. Okay. Next up, we'll know about expense. Expense is the total cost incurred by the development of a particular product or service. An expense does not have any future benefits. The example of expense would be rent, electricity, your telephone bills, etc. Now let's take an example. Say that you are selling a cup of tea. So your one cup of tea would be sold for 10 rupees. Okay, 10 rupees. Now this 10 rupees is your revenue. You would also have certain expense in it. Like to make a cup of tea, you would need what? Sugar. Let's say in a cup of tea, it is rupees 2. You would need tea leaves. That would be rupees 3. And milk would be, let's say, 1 rupee. So now these three sections, 3, 4, 5, 6, your 6 rupees would be your expense. Now, if I subtract my revenue out of the cost that I have incurred, I'll get rupees 4. That is my profit or net income. Now, if I say, can the net income be negative? The answer is yes. So, for example, your revenue is rupees 20 and expense is more than that, 30, then you would have a net income of minus 10. That would be your loss. Next is assets. Now, asset is something that has a future economic benefit to the company. So it can be cash, real estate, investments, machinery, patents, office equipments, vehicles, etc. Now, assets can be divided into two parts. Number one being current assets. Current assets. And the second one is non-current assets. Now, current assets would be something that have an economic benefit within an year. So this is short term. So it would be short term investments or short term account receivables, etc. Whereas non-current assets would be something which drive an economic value after a year. So these are long-term investments or investments in land, investments in equipments, investments in vehicles, etc. Assets can also be distinguished into two other types. Let me show you. It can be distinguished between tangible and intangible assets. So tangible would be something that is physically present, what you can touch or feel, like land, equipments, factories, vehicles, etc. While intangible would be something that we cannot see or touch. That would be patents, copyrights, or even trademarks. These all come in the category of assets. Now let's talk about liabilities. A liability is something that the company has borrowed either from an individual or an organization. So the example would be bank debt, mortgage, money owed to suppliers, tax owed to the government, or even wages that is due to be paid. Now, the liability can also be divided into two parts: short term liability and long term liability. Short term liability would be short term loans, long term liability would be long outstanding loans or mortgages. So these are the examples of liability. Next is equity. Now, equity is the amount of capital that is invested by the promoter of the company. Equity is basically, in layman's terms, the ownership of a company or a thing. Let's take an example. Let's say that you as an individual is buying a car. So the car cost 1 crore. Okay. And you have 20 lakhs in hand with you. And the rest 80 lakhs you take a loan from a bank. Now the 20 lakhs that you have in hand is your equity, and the 80 lakh is your liability. And this car that you bought is your asset. Okay. So basically you have 20% of ownership, which holds true this equation: equity equal to assets minus liability. Equity, that is 20 lakhs, equal to 1 crore asset equity minus 20 lakh 80 lakh of liability. The next module is tracking transactions. So in the previous module, we already learned some of the basic terms and terminologies that are used in accounting, be it revenue, asset, liabilities, equity, expenses, etc. So now in this module, we'll know what are the different ways in which we can know that a transaction is occurring, right? So what is the second question that comes to our brain is, what is the need of tracking transactions? So let's say that you are living on rent and you have paid a security deposit to your owner in cash. So at the end of the tenure, you demand your security deposit back, but the owner refuses to give it, stating that you have no proof that you paid that amount. Now, in this case, what would you do? You have no proof of the transaction. You have no proof that you paid the owner the specified amount. In these cases, it becomes essentially important to have a proof of those transactions. So it can be an invoice, it can be a receipt that is being generated, a bill, we can say. So these are the things that are a must to have when it comes to noting down these transactions in the account books. Now, the first step in the process is knowing that if there is a sale occurring. So what is a sale? A sale is a negotiation between two different parties in which there is an exchange of money with goods or service. So one side should sell a good or a service, it should provide a service. The other side should pay the amount or the money to it. In the earlier times, it used to happen that there would be no exchange of money, but it would be a barter system in which you could give a material or a good, or you can receive a good or a service. But now in this era, you have to give money to avail any goods or service. So that is the first step in tracking our transaction, that a sale should happen. Now, in order to know that a sale is happening, you should either have a receipt to it. Now, what is a receipt? So the receipt is an acknowledgement document that the seller has received the payment by the buyer. Okay, so the example that I gave you, when you are on rent and you are paying your rent, that the owner will give you a document stating that the amount is paid. So that is a financial transaction that is called a receipt. Next up is invoice. Now, invoice is the piece of paper that is given to the buyer by the seller to collect payment. So basically, the difference between invoice and receipt is that in invoice, the payment has not been made, and it is invoice is requesting you to pay that amount. While in receipt, the amount has already been paid and you are getting an acknowledgement of it. Now, the invoice are mostly popular between business to business transactions as they have a lot of transactions in bulk that are due to be paid in the coming months ahead. So that's why it is mostly popular in business to business transactions. Now, another thing is both the receipt and invoice have a lot of things in common, like the order date and the order number would be mentioned in the invoice or the receipt. The description of the amounts that have been sold or bought would be listed there. If there is any tax deductions, it would be mentioned. If there is any discount or a coupon that is applied, it would also be mentioned. Apart from it, it would also have the seller's address and the buyer's address as well. So the last type of transaction that we are looking at is employee compensation or payments. Now, this is very internal to an organization in which as a owner of the company or as a board of director, you would look at what is the total amount that is being paid to the workers, to your employees, and also what are the total deductions are happening. So what type of deductions we are talking about? TDS reductions, that is tax deduction at source. And also, since like it is pandemic going on and everyone is working from home, so the internet reimbursements that are happening, that also are needed to be accounted for. So all the transactions are to be noted down in account books. So after the bookkeeping phase comes the third element of the accounting process called reporting transactions. Now these transactions can be reported by making three financial statements known as the balance sheet, the income statement, and the cash flow statement. Now, just like you and I used to have our report cards during college and school days, similarly for a company, these financial statements act as a report card so that we can analyze how fundamentally strong the company is. We can also know what are the assets, liabilities, what is the expense and revenue of the company, and also what is the equity of the owners in it. So all these informations can be extracted from these three financial statements. Now let's look at the first statement, balance sheet. So balance sheet is the information about the assets, liabilities, and equity of the company. We have already discussed these three terms before, so we'll know where they are placed in a balance sheet. Before moving on, there is a term called an accounting equation. So we'll know what that is. So accounting equation states that an asset is equals to liabilities plus the equity. Now, what does this mean? So this means that the assets that the company owns is equal to the liabilities or what the company owes to its lenders plus the equity of the owner or the promoter of the company. Okay, so this is called an accounting equation. So this thing is really important point to be noted, that asset equal to liabilities plus equity. Now we look at a balance sheet of a FMCG company. So here we have the balance sheet. Okay, before moving on, let me tell you where can you find these balance sheets. So if you go to any company's website, be it Reliance, Adani, or any other company, you can go to their website. So there would be a section called as shareholder information. So you click on that, then you will have a PDF document of annual report. So you click on that, and in that annual report, you will find all these three statements: balance sheet, income statement, and cash flow statement. So now in this case, this is a balance sheet of a FMCG company. This is a balance sheet. Now, as mentioned before, it has three major sections: asset, liabilities, and equity. So we'll know what that is. So the first part here we can see is the asset heading, right? So this part until here is the asset section. Then comes the equity and liability section. So this is the equity section. Okay, wait. This is the equity section. And from here to here is the liability section. Now, assets, as discussed before, has two parts: non-current assets and current assets. Non-current are the long-term assets and the current assets are the short-term assets. Now here we can see the different categories like PPE, property, plant and equipment. So it has an asset value of 20,650 in 2020, and the other side it is also given for 2019. Now, why does the company make a 2020 balance sheet include a 2019 balance sheet figures? Right? This is because if you are a shareholder of the company, then you would want to know what are the changes from the previous years to this year. So that is why they include a section for previous years figures as well. So now we look at what are the different sections. It has a work in process category, then the assets, the loans. Now, why is that the loan is considered in an asset? So this is the value of the loan that is given to us. So we'll make a good use of it in the future. That is why it is considered in the asset section. Later we'll see it will also be provided in the liability section. Then we have other financial assets, deferred tax. Now, these are a very minute things that are also included. The details of this would be in the annual reports under the sections as mentioned in the note section here. So this is the number. So if you look at its annual report, it would have these sections under which the details of the particular thing will be told in detail. Okay, so as we can see, there are some short-term inventories, short-term financial assets that have to be paid before or within a year, right? So these are the current assets. Now, the total asset here is mentioned as 1,61,704 lakh rupees. So this figure is in lakhs, so it is mentioned as 1,61,704 lakh rupees. Now, in the second section, we have the equity part of it. So this is the share capital and the shareholders' equity capital. So these things are also a part of the balance sheet as mentioned. So we'll look at three figures totally in total equity, total assets. Now comes to the liability sections. Now liability has again long-term liabilities that are non-current. So it would be financial liabilities and other financial liabilities for which the total description would be given in the annual report. Other than that, they have current liabilities like short-term trade contracts, micro and small enterprise contracts, and other contracts as well that needs to be paid within a year. So the total liabilities would be 70,798 lakh rupees. Okay. So now, according to the accounting equation, asset equal to liabilities plus owner's equity, so let's see that if that holds true or not. So total assets is 1,61,704 lakh rupees, which should be equal to liabilities is 70, right? So that should be equal to 70,798 plus the equity. Total equity is 90,906. Now, if I add this figure here, what do I get? 7,864,101,77,1,179,16. So we get the exact same figure as of assets. Now this states that our balance sheet is in balance and the assets equal to the liabilities plus equity. Hence, this balance sheet is correct. So the second financial statement that we will discuss is called the income statement. Now, this statement tells us about the company's revenue, expenses, and also the tax incurred on the company by the end of a financial quarter or end of financial year. Now, in a nutshell, this statement provides us the information about the profitability of the company. Okay, so just like balance sheet had an accounting equation, this too has an accounting equation of its own. So in this case, it is the revenue earned by the company minus its expenses would give us the net income. Now, net income can be both. It can be either profit or loss. Okay, now let's look at an example. So here we have a profit and loss statement. So income statement is also called as a profit and loss statement. So we have this income statement from a FMCG company, fast moving consumer goods. So FMCG is basically the company that deals in the daily utilities like toothbrush, toothpaste, biscuits, and all this stuff of daily consumption. So here we have three sections. The first one is the revenue. Then there is this expense part. And lastly, we have the taxation. Okay, so as mentioned, the equation revenue minus expense equal to net income should be valid. So let's look at how it is. So we'll look at the 2020 variant of it, and we can also compare it with 2019. So I'll be taking 2020 for this one. So let's look at the sections of the profit and loss statement. So the first one is the revenue. So now revenue has two parts: revenue from operations. So operations is the day-to-day activities that the company is doing. That's the primary objective. Second one is the other income. Now other income can be the investments that the company is doing in land, or it's renting out spaces, or it's investing in either, let's say, mutual funds or in different companies. So that would be the other income. Okay, the total combination of these two would be the total income. That is 3,04,610 lakhs. Okay, so then it is the expenses part of it. Now, expenses for an FMCG company, it would be the raw materials that it would buy, and also maintaining the inventories, logistic management. So all these things would account for that. Okay, apart from these three costs, there would be the salaries of the employees that need to be paid, certain financial costs like paying the rents or electricity bills and everything like that. Now, the next would be the losses. So there would be certain losses and depreciation in it. So what would be a depreciation for an FMCG company? So these are fast moving consumer goods. So they would have a shelf life or an expiry date in it. So the nearer the material would be to the expiry date, so the lesser cost they have to sell it to the wholesalers. So that would be the depreciation in it. Now, combining all the expenses, we get a total expense that is 2,45,223 lakh rupees. Okay, so if I subtract this total income from the total expense, I would get the profit before tax from operation. So let's see, 304,610. If I subtract it with 245,223. Okay, so if I subtract this, what I will get? What is this? 1, 10, 7, be 8. Then it would be 523, then 10. Okay, 14, 4, 9. Okay, so it is 59,387. That is the exact amount we have profit from operation. So now the case would be if the expenses would be more. So if the expenses were more than the total revenue generated, then it would, the net income would be a loss. But in this case, since the revenue is greater than the expense, it is a profit, right? So this would be mentioned over here. And now we can compare. The net profit had been a little less than the previous year. Okay, so next would be the taxes. So tax would be GST. So it would be a central GST or a state GST or other small tax that are the road tax would be there, toll tax, different types of taxes for the movement of shipments. So in this case, that would also be adjusted, and then the total income tax would be 16,079 as mentioned. So if we subtract our total profit from the taxation, we'll get the exact profit after tax. Okay, that is 43,308. Now let's look at this. So our profit from operations before tax was less than the previous year, right? As you can see. But the taxation for this year is less than the previous year. So our net profit is more than the previous year. So the taxation and everything has also to be accounted in when you are looking at how the company is performing. So this would also be one criteria here. Let's look at another company in which the net income is a loss. Okay, so here we have a profit and loss statement for a airline industry, for a airline company. Now in this case, we can see that we have revenue mentioned and other income mentioned. So now here it is not revenue from operations, actually it is operations only. But in case of airline, it has contracts with customers. Customers buy tickets, right? So here it is that operation income. Okay, then you have expenses. Total expenses is marked here. You subtract total income from expenses. You will get the earnings before taxation. Okay, so different taxes would be mentioned here. Then now in this case, if you actually calculate what is the total here, earnings are positive since the revenue is greater than the expense, but the taxes are pretty high. Okay, so if you subtract this together, this with this, 17,000, 5,007, so it would be 17,339 plus 703 plus 5,450.0.08.12 is there, 0.12 here and 3 4 here. So if you add this thing and subtract this 12th earnings before taxation, 738. Okay, so this comes out to be in the loss side of it. Since the expenses are more, so it will come a loss. So that's why they have written loss for the year. In certain statements, it will just write net income and the figure would be negative. So negative means it's a loss. Okay, so other taxes. So the total loss of the year is 9,347, which has dramatically grew from 2019. So this is not a very good sign when we look at this income statement. So the next and the final statement that we'll be talking about is a cash flow statement. Now, cash flow statement tells us about the cash inflows and outflows of a company. So it is divided primarily into three types. Number one is the cash flow from its operational activities. That is the heart of the business, what they are working for, what is their business for, and all that stuff. So the second one is cash flows from investing activities. Now, investing activity means acquiring land, acquiring different entities in the company. All this thing comes under investment activities. Number third is cash flow from financing activities. Now, this would include rolling out of dividends. So the company rolls out dividend if they are earning really good profits. So it rolls out dividends for their shareholders so that they can share the profits of the company with them. The third one is cash flow from financing activities. Now, this would include rolling out of dividends. So the company rolls out dividends if they are earning really good, if their cash flows are really good. So they roll out dividends to share their profits with their shareholders. And also, they could financing activities would also mean that repayment of interest on different types of loan that the company has taken. Okay, now let's look at a cash flow statement. So here we have a cash flow statement of the same FMCG company. So as mentioned before, that it has primarily three types of cash flows. First is the A part, that is cash flow from operating activities. Now, we have seen it in the income statement, that profit before tax. So it is the same value. Let's check. So in the income statement, we had this profit before tax on operations that was 59,387. Okay, so here we see that is the same amount in cash flow that has been carried forward from the income statement, 59,387. Now there are certain adjustments that are made. Now these adjustments, as you can see from here to here, all this would vary from company to company, sector to sector, it would vary. So now we won't get into this what it is, because it would have been different for an airline industry, for an FMCG company, for a motor company, and all these things would be different. So there are certain adjustments that need to be made, certain property, land recoveries, logistics, losses or incomes that should have to be adjusted for. So that is mentioned in this section. So after adjusting, we have a net profit of 63,548. After that, the working capital that is required for the company, it also has certain adjustments in their inventories, trade practices, and all this stuff, financial assets. So these things are also adjusted. It can be plus or minus. So increase is mentioned in brackets. So this is minus, decrease plus, this is minus. After this, we'll get a net amount of 61,759. Now, this is the cash that is generated from these operational activities. Now, they would incur certain taxes on it. So, after subtracting the taxes, we will get a net amount of 47,405. So, this was part A. I'll just mention that 47,405, or I'll mention in the next slide. So, the second part is, wait, first I'll mention 47. What was it? 405. Okay. So now the second part is the cash flow from investing activities. Now I already mentioned you what it is. So it is the loans that are released, the interest release, the payment acquisition of land, property, and sale of any equipment if there is any. So these things are also added, subtracted in the way it is. Now the total net cash from investing is this 7,472. So we'll add 7,472 to it. Now cash flow from financing activities is most of the times in negative, because these are the things that are rolled outside of the company, like dividends are paid to the company, the interest on the loans is paid back to the banks. So in this case, all these things would be subtracted, so the net cash in financing activities would be negative. Okay, these all would be negative. Interest on liabilities, interest paid on lease, principal payment of liability, dividend, and dividend tax paid. So all this is negative. So we have a negative figure. It's in brackets of 19,063. Now, what should be in brackets and what not? That would depend. It would have some of the values could be positive and negative. You have to actually see which one is positive, which one is negative. So in this case, this financing activities is negative. So I'll add both of the A and B. From operation investing I'll add, and financing I'll subtract 19,063. Now I will get the net value that is mentioned over here, 35,814. Now, what happens in this case is that it is rolled, there is a cash and cash equivalent at the beginning of every year. So, that is basically the end of previous year's cash flow statement's last entry, that is cash equivalent. So, as you can see, year ended in 2019, you had a cash equivalent of 52,590 lakh rupees. So, this added with this year's cash equivalent, so this value here is posted here, because the end of previous year's cash flow entry would be this year's beginning cash flow entry. Okay. So this added with the net increase in cash flow would give us the equivalent for this year's end, 2020's end, and it would be marked as 2021's beginning. Okay. So these are the three things in cash flow statement that needs to be known: cash flow from operation, investing, and financing. Okay. Next, we look into some of the accounting concepts that are a must to know when we start accounting. So the first one is separate entity concept. Now this states that the owner and the company are two different terms, they are two different entities. Now you would ask me, hey Madhur, we already know this, that a company and an owner are always different, so why do you want to make a module out of it? I'll tell you why. So when you start a company from scratch, let's say you are having a startup or you start your entrepreneurial journey, so it becomes really important to not mix yourself and business together. I'll show an example. Let's say that I have a restaurant. So, okay, I have a restaurant. Now, this is my personal self and this is my business self. Now, what does this mean? This means that if I have a restaurant, then I'll invest some of my personal stuff in the business. I'll give an initial capital. I'll give a capital to it. Let's say 60,000. Now that business with that 60,000 will purchase stuff like raw materials for cooking. It will get some staff. It will give employment. and let's say it then sells dishes to earn revenue, right? So in this case, let's say that the company is profitable. So it will get some profits that will go to the company C. Now these profits are owned by the company, but it is a property of me because I am the owner of it. So now this business will transfer its profit to me, right? So in this case, how a separate entity works. Now the profits will directly not go into my account. It will come to first the business account and then it will be transferred to my own personal account. Now what happens if the business has taken some loan, right? And my restaurant has some land in it that is owned by the business. Now let's say if my personal self and the business, they are not separate entities but are together as one. So now in this case, if by chance the business defaults on the loans, the collateral will be of the business and me together. Now this can create an issue because then my personal assets will also get sold, which is a problem, right? So that is the reason why business should be separate. So the loans that will be issued are purely on the business land or for the business, not for my personal self. Therefore, it becomes essentially important to have two separate entities, one for my personal self and the second one for business, even if I own 100% of the business. The next accounting concept is going concern concept. Now, this is a very interesting concept which states that the company or the business entity should continue to run its operations for a very long time in future and also should not shut its operations midway. There can be certain reasons for that. For example, if the promoter of a company dies or a board of director resigns, the company should keep running its operations for a foreseeable future. This also states that the revenue of the company should only be charged for the things it utilizes. Let's say the company has taken a loan from a bank for 5 years. Now, in that 5 years, the company should utilize those funds to grow the company forward and should not let that fund be left unutilized. Another point in this concept is that the company should not liquidate itself. Now, what does liquidate mean? Now, liquidation means to shut down all the operations and selling off all the assets to repay any debt it has from banks or other entities. So, this concept makes an assumption that the company is reliable, consistent, and maintains continuity for a foreseeable future. This is also about being optimistic about the company, that its assets and resources will grow over time. So, all the business transactions and other long term third party contracts are held in a belief that the company will run its operations for a very long time. Let's take an example. So if the company, let's say, buys expensive machinery of 60,000 rupees, so and it assumes that the lifetime of that company is 6 years. So 6 years. This means that for all three, so this means that for all those 6 years, each year that company uses that machine's worth of 10,000. So the next type of accounting concept is called a double entry concept. So this is the most important type of concept in the accounting world. It has many other names, like it is also called as dual aspect concept, dual transaction as concept also. Okay, so for understanding this, first we need to understand what is a debit and credit. Okay, so let's say that you are buying a phone of 5,000 rupees. So 5,000 you will pay to the seller, right? 5,000. Now this amount is going out of your account to someone else's account, right? So this money is going away from you, right? Similarly, let's say a friend gave you 5,000 rupees as a gift. Okay. So this money is coming to you, right? So debit is something what goes out, credit is something what comes in the accounting terms, right? So now you understand. For example, you have also seen many messages when you withdraw money from your account, right? So the message comes that some XXX amount is debited from your account. Now this is what goes out of it. And if for example your salary comes to your account or something like that, or someone sends you money, then the message comes from the bank as this amount is credited to your account. So credit is what comes in, debit is what goes out. Now coming to the double entry concept. So this states that any transaction in the world has two aspects of it. One, what goes out, second, what comes in. So let's say that you are going to buy vegetables, right? So buying a vegetable, you would give cash. So cash would go out of you while the vegetables will come to you, right? So there are two aspects involved in it. So in the accounting terms, that entry will be made into two different accounts. One would be the vegetable account, the other would be the cash account. So the cash would deplete while the vegetable account would increase, right? So let's take another example. If you're buying a table or a camera or a phone, so in that case also, if when you are transacting a money to someone else, it is reducing your cash account. While you're getting something, a camera or anything, your camera account would increase, right? What is this camera account or vegetable account I'm talking about? It is the asset account that you would increase, right? So there's one more thing, that double entry does not mean you make two entries in the same account. It is two entries but in two different accounts, and they are two different types. One is going out, the other one is coming in, right? So what is the benefit of it? It has four major benefits. First, it gives you a clarity of how the your business is performing, or also to maintain good accounting records. In an accounting world, the transaction is accurate when it is correct up to two decimal places. Thirdly, it would give a good holistic view of the company finances, how the company is doing, and it would reduce any bookkeeping errors if they occur, right? So these are the four key benefits of double entry concept. Next, we talk about matching concept. So in this concept, I'll explain you with the help of an example. Let's say that you are a retail seller and your business is of selling phones. Let's say that in order to sell phone, you purchase 20 phones. So I'll say by quantity and revenue. Okay. So let's say that you bought 20 phones for 10,000 rupees value. Okay, so your total buying cost is 2 lakhs, right? Now you sell that same phone for, let's say, 15,000, and you sell quantity is 10. So your net revenue is 1 lakh 50,000. Okay. Now, seeing these two things, your buy price and selling price, you would say that, you know what, it is a 50,000 rupees loss, right? You would conclude that it is a 50,000 rupees loss. But is it so? Now, matching concept tells us that if you are looking at the revenue, then we need to first look at what is the cost incurred to gain that revenue, right? So in this case, we only sold 10 quantity of 15,000 value, right? So what would be the cost incurred for this 10 units? That would be 10 into 10,000, since we bought it for 10,000 rupees. So the total cost for that 10 phones would be 1 lakh rupees, right? Now if I subtract that 1 lakh from the selling price of 15,000, I will get a net 50,000, and that would be my profit, right? This would be my profit. Therefore, the concept of matching defines and states while preparing an income statement, so the revenue is corresponding to the relevant expenses. We cannot change the quantity of different things and then say that, okay, the revenue is deferred or it is a profit or a loss. We cannot conclude until and unless we have seen the cost in which it is made, right? So this was matching concept. So now, after learning about all the basic terms and terminologies like asset, revenue, bookkeeping, receipts, invoices, also after getting to know about the different accounting concepts, now we are in the position in which we can actually know how the accounting cycle works and what are the various steps that are involved in it. Okay, so let's look at the accounting cycle. So it has primarily 7 steps. So let's look at each one of them. So the first step of the counting cycle is the collection of various transactions. Now, this is our first step. Now, we already know how we track these transactions. It is through receipts, bills, invoices, and so on. So, in the same way, we will know each one of them by their bills. So, we will collect all of those transactions. We'll collect the invoices, the bills, the receipts that have been generated that are kept with us. So, we'll all collect that and store in one place. Now, the second step of this accounting cycle is to record into a journal. So we need to make a journal entry. So I'll tell you what a journal is. So journal is basically a book in which you note down what are the transactions that are happening. I'll show you the example of how a journal looks. So in accounting, this is how a journal looks. So it has a journal number over here. That is the starting. So this journal number is unique. Now this tells you that various types of journals that are present. So this would give you a look at what it is. Now the first step is to writing the date. Now this is important because it will tell you at what date that particular transaction happened, the posting date of it. So that we'll mention it over here. Then second column comes the account. Now there are a lot of different types of account in accounting, like the cash account, the cost of goods sold account, the inventory account, the receivables account. So all these are different types of account. Now the third and the fourth columns are debit and credit. Now, as we have learned in one of the accounting concepts, the double entry concept, in which every entry has to be made into two different accounts, right? So here in this case, our first account is cash and the second account is inventory. Okay, so now these two things are mentioned over here, but you can see that there's a little gap in between, right? This is to differentiate between what are debit entries and credit entries. Now in cash account, the money is debited, so it is written as debit. In the inventory account, the money is credited, so it is in the credit side of it. Okay, so that is why all the credit entries to have some space from the start. So that is why this gap has to be maintained. And this is one entry, right? So there can be n number of entries down here of various accounts. Okay. The most important part of it is that the total debit here should be equal to the total credit. Okay. So that is very important in a journal entry, that all the debit side and the credit side should match. Okay. So the next phase after journal entry comes maintaining a journal ledger. So the journal ledgers are basically the accounts, the combination of various journal entries into one single book, right? That is called as a journal ledger. Now the difference is that earlier times we did not have a modernized journal ledger. It used to be most of the times something called as T accounts. So T accounts would look something like this. On the left side would be debit, on the right side would be credit. Okay. So these were made for all the different types of accounts. Like let's say there's a cash account, there is a accounts payable, right? So these T accounts were made for every single type of account, and those were to be clubbed together to make a one general ledger, right? These were known as sub ledgers. Sub ledgers. Okay. So on the left side is debit, on the right side is credit. For example, you would have to give, you are liable to pay 3,000, let's say $4,000, right? So you will debit $4,000 from the cash account, and you will credit the same into the accounts payable section of 4,000. Okay, so then there would be one book that would combine the two into recording things, right? That is known as a journal ledger. That's all. Next is trial balance. Now, trial balance is a document that is required to be made to ensure there are no errors involved in the accounting process. Now, the errors could be you may skip an entry, you may skip a transaction in one of your accounts, or you may replace the debit side entry to a credit side entry. Or even you can make two entries of the same transaction in one single account. So, all these mistakes have to be taken care of when we are dealing with a large scale business, right? In which multiple transactions happen every single minute. So this is why it becomes important to proofread everything, right? So let's see how a trial balance look. So a trial balance can be posted on any given time in an accounting period, right? So for a trial balance, first we need to know the end date, which date it is posted. So that would be the top heading of a trial balance. Then we have three columns. The first one is the accounts. So which type of accounts are utilized in the transactions? So these are mentioned in the first column. The second column is the debit side, and the third column is the credit side. So all the transactions happening would be taken care of in this. So different accounts would have different entries that need to be put. So in a typical layout of a trial balance, so the first entries, the first accounts are mostly assets. Then comes the liability side of it. Then comes the owner's equity, revenue, and expenses. So this is a general layout of how a trial balance is. First comes the asset, then liability, equity, revenue, and expenses. So this is the way. Similarly, like a journal entry, in this also, you have to make sure the total debits is equal to the total credits, right? So everything needs to be in the perfect order. The equation should satisfy debit equal to credit. Okay, so after covering all the four steps, we come to the fifth step, that is adjusting entries. Now, let me explain you how it is with an example. In India, the financial year is considered to be from 1st April to 31st of March. 1st April of, let's say, 2020, 31st March of 2021. Now, there can be some situations in which some of the payments are done in between of these accounting cycles. So, for example, one of the purchases is done on 30th of March, right? So now it becomes complicated to know where to put these transactions, either in the previous accounting cycle or the new accounting cycle, right? So this happens in mainly two cases. The first one is known as prepayments. So the good you haven't received it yet, or the one that you have not purchased yet, but the payment is done, right? So it is called prepayments. And the second would be a deferred revenue. So now these things have to be taken care of, where to put these payments or where to put the deferred revenue. So all these calculations are involved in the adjusting entries that a company does. Next is preparing financial statement. So we have already discussed the three main financial statement, that is the balance sheet, income statement, and cash flow statements. So after this process, all the data that we get, all the numbers that we get are then aligned together to make three financial statements, right? After preparing these financial statements, and the last step of the financial accounting cycle comes closing entries. Now, what are these closing entries? So, after finishing all the processes, be it journal entries, be it posting in a ledger account, be it checking if the debits is equal to the credits, or adjusting those entries and making all the financial statements, in this step, all the temporary accounts, be it ledger accounts or be it journal entries, everything is set to zero for the next accounting cycle. And all the things that are left over are sent to the owner's equity, because at the end, they are our major stakeholders in the company. So everything, be it profit or loss, is transferred to the permanent accounts of owner's equity. So this happens in an accounting cycle. Now let's look at what we learned in this course. So we started by knowing what is accounting, what are the different types of accounting. Then we moved on to knowing what does bookkeeping means in accounting, what is the importance of bookkeeping. Then we talked about the phases of bookkeeping process. First is creating a record keeping system. Second is tracking those transactions, right? So that we learned. The third part, reporting these transactions. We learned to make three of the most important financial statements called the income statement, balance sheet, and cash flow statements. After that, we looked at some of the most important accounting concepts that are a must to know when it comes to accounting. After that, we had a step by step analysis of different steps involved in an accounting cycle.
Accounting concepts in the bookkeeping. Okay, while recording all the transaction, they are going to consider these 9 accounting concepts and 4 accounting conventions. Then only they are going to record. That we already discussed, correct? So we'll see what are the 9 accounting concepts. So this first one, business entity concept. What do you mean by this business entity concept? So business means here the two parties will be there, correct? One is the business and one is the proprietor, that is owner. So while recording the transaction, he needs to maintain his books of accounts in a manner that the business transactions are different and his own, that is personal transactions, are different. In that way, he needs to maintain the books of accounts. So sometimes what happens, intentionally, the proprietor, they are going to record his personal transactions also in the business transaction or in the business books of accounts. Why? Because to show the lesser profit, to manipulate the books of account, that is for window dressing, they're going to use these tactics. Okay, so as per the business entity concept, the business is separate, the entity, that is the proprietor personal, is different. So these are the two different entities are there, so we cannot merge. Okay, we need to separate, we need to maintain separate for business and we need to maintain separate accounts for proprietor. Second one, going concern concept. What do you mean by this going concern concept? All the business or all the activities or trade, they are not going to start for 1 day or 2 days or for week. Okay, if I'm going to start a new business, means my intention is to, I need to sustain in the market for a long run, at least for a 15-20 years or 50 years or 60 years, correct? So all the business, they are going to start with that intention only. So they need to sustain in the market for a long run. That is the going concern concept. We need to look at the future. That is going concern concept. Next, cost concept. Cost concept is nothing but whatever the transaction we are going to record, okay, that we need to measures in terms of money, correct? But we need to calculate also the per unit. If for example 15,000 rupees is the fixed expenses for per month for a factory expenses, so in that 15,000, how much is the per unit cost, that we need to calculate, correct? So for that purpose, they are going to use this cost concept. Next, dual aspect concept. Dual aspect concept, I think so you already heard this word, or you are going to read these two words frequently, that is debit and credit. Whatever the banking transaction you are going to do, you will get a message or you are going to get a mail stating whatever the amount debited or whatever the amount credited, all the transaction you are going to get, correct? So debit is nothing but when cash goes out or money goes out from the account, then we are going to get debit. And whatever the money we are going to receive or that amount comes to our account, then we will get the credit message. So debit is outflow, credit is inflow, in a simple word. So all the transaction, we have this debit and credit, that is two side effect. That is the dual aspect concept. Next, money measurement concept. Money measurement concept is nothing but whatever the transactions or all the activities we need to record in terms of money or money's worth only. Okay, we cannot record the transaction in terms of kilogram or millimeter or whatever the other. Okay, we cannot measure, correct? So we need to measure in terms of money only. Accounting period concept. Accounting period concept is nothing but all the books of accounts or all the companies, okay, they need to maintain in a systematic manner. That is 12 months. It starts from the 1st April of this year to ends with the next, that is 31st March of the next year. All the companies, they need to follow this accounting period concepts only. If the accounting concept is not there, then I can maintain or I can record my books of accounts or I can maintain my books of accounts for 6 months, 3 months or 8 months or 12 months. Whatever it is benefit for me, I'm going to record like that, correct? Other company, they are going to record their own period or accounting period, correct? So for that purpose only, they are given this accounting period concept. So all the companies, they need to maintain their books of accounts. It consists of 12 months period starting from the 1st April of this year and ending on the 31st March of the next year. Realization concept. Realization concept is nothing but for all the assets. Okay, we have three varieties of values are there. First one, original value. Second one, book value. And third one, it is realized value or market value. Okay, all the transactions, okay, all the assets transaction, we are going to record first at the original cost. Once we deduct the depreciation, then we will get the book value. So we need to know what is the actual or realized value. Means the market value is the realized value. That is the correct value for the assets that we need to record. Matching concept. So all your books of accounts we need to match. For example, if we start with the debit side, if for example, if we are going to start the individual ledger account, we are going to start with the opening balance, means we need to close with the closing balance, or we need to end with the closing balance, and then we need to match the opening balance and closing balance. If it is difference is there, balance carried down or balance brought down, that we are going to do, correct? Like that. Or for example, trial balance, we need to match our debit side with the credit side. In the balance sheet, we need to match our asset side with the liability side. So we need to match both the sides. And the last one, objective evidence concept. So objective evidence concept is nothing but for all the activities or all the transaction, whatever we are going to record, for that we need to supporting with the evidence or supporting with the documents. I've already explained you regarding this, correct? So if they are not going to give the evidence or proof or documents, means that we are not going to consider as a business transaction, that we are going to consider as a non-business transaction. So we need to give the documents for all the transaction. So these are the 9 accounting concepts are there. Accounting conventions. In this, we have 4 accounting conventions are there. First one, convention of disclosure. Convention of disclosure is nothing but we need to disclose the books of accounts. In this video, I've already told you all the companies, they need to disclose their financial statements in their website. Okay, for the purpose of public or stakeholders, for any other purpose. Okay, they need to publish. So they need to disclose their books of accounts. Second point, convention of consistency. So consistency, you all know, they need to maintain a uniformity, correct? That is the consistency. So convention of consistency is nothing but the company needs to maintain the consistency in the method of accounting. While it comes to depreciation, we have straight line method, WDV method, annuity method. So the company, they need to maintain uniformity. If for example, 1 month in a year, they are going to use straight line method, other 6 months, they are going to use WDV method, in another 6 months, they are going to use some other methods. Okay, that is wrong. they need to maintain a same method for the particular year. If they want to change, yes, for the next year they can change, but in this year they cannot. That is they need to maintain the consistency. That is the convention of consistency. And the third one, convention of conservatism. So convention of conservatism is nothing but they need to maintain all the books of accounts in a systematic manner, and they need to show it to the other stakeholders. And the last one, convention of materiality. So convention of materiality is nothing but they need to record all the transaction, whatever the possible losses are there. Okay, they need to show, and whatever the possible profits are there, they need to disclose to the accounting, or they need to show in the accounting. That is materiality and immateriality will be there, that they need to showcase. That is the convention of materiality. And calculating this materiality and immateriality, it is very difficult. Golden rules of accounting, like it is a base for the accounting. Okay, without these golden rules of accounting, we cannot do any other books of account, or we cannot maintain any books of accounts. So these golden rules of accounting broadly classified into three categories or three accounts. That is personal account, real account, and nominal account. So we'll see one by one. So personal account, in this we have artificial person. Okay, whatever the persons comes in the organization or in the business, okay, there comes under this personal account. For example, debtors, creditors, capital. Capital is a representative person, because the capital who is invested, the owner or the management is invested, correct? A representative person. All these categories of persons will comes under the personal account. So in that, debit is the receiver, credit is the giver. For example, we are going to receive money from our customer. So customer is going to pay money. So who are going to receive? The company is going to receive the money, correct? So company needs to debit. And who is the giver here? The customer is the giver, or he is going to pay, correct? So we need to credit the customer. Real account. So in this real account, all your assets, okay, it comes in the real account. For example, purchased plant and machinery. If you purchase the plant and machinery, what comes to the business? Plant and machinery comes to the business. And what is going out? Cash is going out. Correct? So debit, what comes in? So plant and machinery comes in. So plant and machinery account debit. 2. What goes out? Cash is going out. So cash account credit. So this is the real account. Next, nominal account. All your expenses, liabilities, okay, and incomes will comes under the nominal account. So debit all the expenses and losses. Whatever the expenses or losses are there, okay, that will comes under debit side. For example, rent paid, commission paid, destroyed by fire, okay, or loss on sale of assets. All this comes under the debit. And credit, all your income and gains. Whatever the sales or whatever we are going to receive, commission, interest, rent, all this comes under the credit side. So debit all expenses and losses, credit all income and gain as per the nominal account rule. Okay. So this rule first we are going to use in the journal entries. So while passing the journal entry, this is the base for the journal entry. From that journal entry only, we need to start, and then we need to post it to ledger account, trial balance, and financial statements. Here we have the summary. We will quickly recap whatever we have discussed in this video. So in this video, we have discussed bookkeeping. So bookkeeping is also called as preliminary books of accounts. So without this bookkeeping or without this recording, we cannot continue with the other books of accounts or other original books of accounts. So that is the first one we have discussed. Next, accounting. So we have discussed the definition of accounting and the process of accounting. Next, we have discussed functions of accounting, that is recording, classifying, summarizing, analyzing, interpreting, and communicating. So these are the 6 functions are there. We have discussed process of accounting, that is bookkeeping, journal entry, ledger account, trial balance, and financial statement. So this is the flow. In this flow only, we are going to follow our financial statement. We have discussed difference between bookkeeping and accounting. So what are the bookkeeping and what are the accounting? That is also we have discussed. Users of accounting. So in this user, we have broadly classified into 2 categories, that is internal users, external users. So in the internal, we have owners or management, investors, managers, and employees are there. And external users, lender, suppliers, customers, competitors, and government and the public. So these are the users of accounting. Elements of accounting. So 5 elements are there, that is assets, liabilities, revenue, expenditure or expenses, and the capital. So these are the 5 elements of accounting. Types of accounting: financial accounting, cost accounting, management accounting. So these are the 3 traditional types or branches of accountings are there. While it comes to new or recent accounting types, that is tax accounting, human resource accounting, and corporate accountings are there. And we have discussed accounting concept. We have 9 accounting concept: business entity concept, going concern concept, cost concept, dual aspect concept, money measurement concept, accounting period concept, realization concept, matching concept, and objective evidence concept. So these are the 9 accounting concepts are there. And we have 4 accounting convention, that is convention of disclosure, convention of consistency, conventions of conservatism, and the convention of materiality. Golden rules of accounting, that is personal account, real account, nominal account. As per the personal account rule, debit is the receiver, credit is the giver. As per the real account, debit what comes in, credit what goes out. And as per the nominal account, debit all expenses and losses, credit all income and gain. Bookkeeping. So we have known the word bookkeeping, correct? So in the accounts, we are regularly using this word bookkeeping. So today we will discuss about what do you mean by this bookkeeping and other things involved in the bookkeeping. So first we'll see the agenda. First one, introduction to bookkeeping. Second one, meaning and definition of bookkeeping. Third one, objectives of bookkeeping, elements of bookkeeping and accountancy, methods of bookkeeping, difference between bookkeeping and accounting, single entry system of bookkeeping, double entry system of bookkeeping. So these are the few points we are going to discuss in this session. So first we'll start with the introduction to bookkeeping. So the bookkeeping is also known as primary books of accounts. In general terms, bookkeeping is nothing but whatever the activities or whatever the transaction, okay, that we are going to record. If you take example of any company or any organization. So if you want to go and you need to visit one person in that XYZ department. So the security is not going to allow directly, correct? So you need to go first, and there we have one ledger book. Okay. In that ledger book, what is your name or what is the mobile number, at what time you are going inside, and what is the purpose of visiting, and for whom you are going to meet. Okay. All this information you need to write in the ledger book, correct? Like that only in the business or in the organization, they are going to take or they are going to record all the transaction. It may be monetary or non-monetary activities. They are going to record in one ledger book. That we call it as bookkeeping. And it is very, very, very important in the organization. So this is the base for all the accounting. Okay. If we have the transaction, then only we can go with the further books of accounts. So it plays a very important role in the organization. The aim or main intention of all the business is to make profit. Okay, all the business or all the organization or all the activities, okay, whosoever is going to do for the purpose of money or for making the profit only, they are going to do all the activities, correct? So that is the first or prime objective of all the activities. Profits is nothing but excess of income over the expenditure. So how to calculate the profit? Whatever our expenses and whatever our incomes are there. So incomes minus expenses, if it is positive, then it is a profit. If it is a negative, then it is a loss, correct? So if you want to get to know how much income we have earned and how much expenses we have paid, means for that purpose, yes, we require this bookkeeping. If you miss any one entry of income, or if we miss any entry of expenses, then we will not get the accurate profit or loss information, correct? So if you want to get the accurate profit or accurate loss information, means yes, we require this bookkeeping. Okay, recording the transaction or activities in the organization. Yes, here in this bookkeeping, they need to record all the transaction. It may be related to the money or monetary value, okay, that they are going to record. For example, what are the transaction? Okay, they can record in the bookkeeping. Means the first one, billing of goods sold or service provided to customer. If for example, the company sold 5 units of goods to XYZ customer on the basis of cash. Okay, so if a record that 5 goods they have sold and what is the cash comes to the business, that they are going to get. If they're not recorded or if they're not keeping in the ledger book, means yes, they are going to miss the transaction, correct? So second transaction, paying suppliers. Whatever the goods we have purchased from the creditors, for that we are paying now, that is paying to suppliers. Recording depreciation on assets. So recording depreciation, that is not the monetary, it's coming to the business or going out of the business. Nothing will happen. Only the fund flow will be there in the organization. Within the organization only all the transaction will be there. So that is also we need to record. So recording the depreciation on assets. So next, all the other transactions in a organization, not only cash flow or fund flow, all the activities, whatever the day-to-day operating activities done in the organization, they need to record in the bookkeeping. Okay, so this is the brief introduction about the bookkeeping. Next, meaning and definition of bookkeeping. So we have seen what is the brief introduction about the bookkeeping. Now we'll see the what is the meaning and definition of bookkeeping. So the bookkeeping is the art of recording business transaction in the books of accounts in an ordinarily manner. So for this, no need to maintain any specific, okay, or format or any other books of accounts. Just we need to record in a systematic way. Okay, whatever the transaction is taking place, according to that, we need to record the all the transaction in the ledger book. Definition is the science and art of correctly recording in the books of accounts all those business transactions that results in the transfer of money or money's worth. So it is the science and art. Okay, so maintaining a book or maintaining the all the transactions in the books of accounts, that is the art and science. Okay, in a systematic way we need to record all the money and money's worth transaction so that we will get the accurate result at the end. If you are not recording properly, then we are not going to get the accurate results also. So bookkeeping involves the following process. So what is the process of this bookkeeping? Okay, we have 4 steps or 4 process involved in the bookkeeping. So first one, identifying accounting transaction. Okay, so only which are all related to the accounting. So only money and monetary worth transaction we need to record, correct? If, for example, someone is visited the organization, or someone is came for the interview, or someone came for the getting the estimation, okay, estimation of products. If we given the bulk order, what price he can get the products. Okay, for that purpose they are going to come. Although transaction will not be recorded for the accounting, that is not necessary, that is not required also, correct? So only money and monetary worth transaction we need to record, that is helpful or that is useful for the books of accounts. Second step, initial record of accounting transaction. Okay, all your books of accounts, okay, either it may be a journal entry, trial balance, ledger account, P&L account, balance sheet, all your financial statement. First step, we need to start with the bookkeeping. Okay, first, if you have the transaction, where you will get the transaction? From the bookkeeping or from ledger books only you will get the transaction, correct? So from that transaction only you are going to start with a journal entry. After that, from journal to, we are going to post it to ledger account, from ledger to trial balance to P&L account, P&L account to balance sheet we are going to prepare, correct? So for all the books of accounts, the first step or initial step is to recording the transaction or the bookkeeping. That is the first step. Third step, preparation of ledger account. Once the pass the journal entry, okay, from the initial book to journal entry, if you pass the transaction means, second step is to, we need to post it to the ledger account. So ledger account is nothing but the individual account for the individual items, that is for assets, liabilities, expenses, okay, or persons, okay, that we are going to maintain separate ledger account. That is your date, particular amount. So this is the format for ledger account, correct? So with that format, we are going to post it to all the journal entry into ledger accounts. So there we will get the closing balances of all the individual account. So from that closing balances of individual account, with that closing balances, we are going to prepare the trial balance. Okay, your trial balance format is serial number or date, particulars, debit, credit. So in your debit side, all your assets, expenses and losses, that we are going to record, and at the credit side we are going to record all your income, gains and liabilities. This we are going to record it at credit side. Okay, once we get the closing balances, then we need to prepare the trial balance. So these are the 4 steps involved in the bookkeeping. Next, objectives of bookkeeping. So these are the 3 major objectives of bookkeeping. We have n number of objectives are there, but in that only these are the 3 main or major objectives are there for bookkeeping. So first one, it provides a permanent and systematic record of all the business transactions. Okay, so whatever the journal entry we are going to prepare, or whatever the ledger account we are going to prepare, that is, we are going to prepare monthly wise or quarterly wise or yearly wise. But this transaction, that is bookkeeping, we are going to record from the day 1 of the company to the till the date of closure or closing down the company. Till that time we are going to record all the transaction. Okay, while comes to methods of bookkeeping, I will tell you we have 2 different types of or methods of bookkeeping. One is traditional method, one is computerized method. Okay, in any one form they are going to record all the transaction in the organization. This will be the permanent for the organization from the day 1 to day closes of the organization. Okay, all the transaction will be recorded in the bookkeeping. So second objective, the periodical results as to profit or loss should be readily and accurately ascertainable. Okay, if for example sometimes we have done the error or if I have done the mistakes in the journal entry, so all your books of accounts will be wrong, correct? But when we need to calculate again means, yes, again we need to start from the bookkeeping. that is from our primary books of accounts. All the transaction will be available. So we need to start with the scratch, or we need to start with the zero to financial statements. Correct? So for that purpose, this bookkeeping will be useful. And the last objective, to enable financial data to be supplied for management of business. So this management or the organizational owners, okay, they will take this financial data, or for this bookkeeping, all the transaction will be recorded, correct? So they are going to take, and how much day-to-day transaction they are going to happens in the organization. For that purpose, this management or the owners, they are going to use this bookkeeping. So these are the major objectives of the bookkeeping. Next, elements of bookkeeping and accountancy. So what are the main elements or involved in this bookkeeping? So which are all the books they need to maintain either in a traditional method or in the modern method, or else in the manual entry or computerized entry they need to maintain, correct? So we'll see which are the elements are there in the bookkeeping and accountancy. First element is books. Yes, the word only indicates books. Here in these books, we have 8 different kinds of book they need to maintain. Okay, so we'll see one by one. So here we have the list of books they are going to maintain in the bookkeeping. That is first one, cash books, purchase books, sales books, purchase return books, sales return books, bills receivable books, bills payable books, and journal proper. So these are the 8 books the company needs to maintain in the bookkeeping. So we'll see one by one. So cash book. So in the cash book, what they are going to maintain? So in the cash book, whatever the cash inflow and cash outflow is there. Okay, whether it may be a cash received by the company or cash paid by the company. Okay, all those transactions will be recorded in the cash book. So second one, purchase book. In the purchase book and the sales book, specifically they are going to maintain only the purchase entry and sales entries in the books. So next, purchase return books. So in the purchase return, the company is going to purchase the goods from the suppliers, correct? Or from XYZ person, they are going to purchase the goods. So after brings that goods to the organization, some goods were damaged or some were not up to the mark. Okay, either it may be in the quality or color, whatever it may be. So for that reason, we are going to return the goods to our supplier. So that we are going to record in the purchase return books. Next, sales return books. Okay, how we are going to return to the supplier, like that whoever purchases from us, they are going to return due to whatever the reasons. Okay, so on that time we are going to record all the sales return transaction in the sales return books. Next, bills receivable books. So the company is going to allow some credit payment or credit repayment period, correct? For example, 30 days the company is going to allow for their customer to repay the money. So within the 30 days, okay, we need to maintain all the records, correct? So that we are going to maintain in the bills receivable books. Next, bills payable books. So what are the bills or whatever the vouchers the company needs to pay to the others? That is the liability, correct? So that they are going to maintain in the bills payable books. And the last one, journal proper. So this book is going to maintain if any transactions, okay, having the error, or if you pass any journal entry mistakenly, or if you have done any error in the journal entry. So on that time, if you want to correct the journal entry, then we are going to pass some entries in the journal proper. So these are the first elements of bookkeeping. Under the books, we have 8 different kinds of books the company need to maintain in the bookkeeping. That is the first element. So we'll see what is the second one. So second element is ledger. Accounting ledger is an account or a record used to store bookkeeping entries for the balance sheet and income statement transaction. Balance sheet in the sense all your assets and liabilities information. And income statement transaction. So income statement transaction is nothing but whatever the cash inflow and outflow, that is your income and expenditure, okay, that they are going to maintain in the ledger account. So accounting ledger journal entries can include accounts like cash account, receivables, investments, inventory, accounts payable, accrued expenses, and customer deposits. So these are the individual account they are going to maintain in the organization. So ledger is nothing but whatever the we have passed the journal entry. For all the journal entry, individual ledgers account will be open, and for that we are going to calculate the what is the opening balance and what is the closing balance, that we are going to find in the ledger account. So individually, like for cash, they are going to maintain this ledger account. This is the format for ledger account: date, particulars, amount, date, particulars, amount. So this is debit side and this is the credit side. On the top of this we are going to write cash account. If for example we are maintaining investments or investments account or inventory account or accounts payable, accounts receivable, like that individual account we are going to maintain in the ledger account. So whatever, if for example cash, okay, so all your inflows, cash inflows to the organization we are going to maintain at the debit side, and all your cash outflows we are going to record it at the credit side. For example, inflows, sales. If you made the sales, what you are going to receive? We are going to receive cash, correct? So any interest received, commission received, okay, that we are going to record it debit side. And when it comes to credit side, for example, plant and machinery purchased, so on that time we need to pay cash. Goods purchased, okay, rent paid, electricity paid, okay, all those things will be comes in the credit side. So that is the ledger account. Next elements, that is third one, trial balance. Trial balance is nothing but all the ledger account, okay, whatever we have prepared individuals account, there we are going to get the closing balances. So once we get the closing balances, we need to prepare the trial balance, okay, whatever the closing balances are there, that we are going to take into the trial balance, and then we are going to prepare the trial balance. After the trial balance only we are going to move to the all our financial statements, that is your income statement, P&L account, and balance sheet, okay. So this is the format for trial balance, okay. So date, particulars, debit, credit, only 4 columns will be there here. Either we can maintain date or we can maintain serial number. According to ledger account we are going to maintain the serial account here. So in the particulars, whatever the individual account, for example cash, inventory, receivables, investments, that all those things we are going to record in the particulars. And when it comes to debit side, in the debit side, all your assets, expenses, and losses we are going to record in the debit side. If for example debit side, all the assets, cash, furniture, plant and machinery, building, and expenses like rent, electricity, water charges, depreciation, we are going to record it at debit side. And when it comes to credit side, all your liabilities, income, and gains. For example, liability, capital, bank loan, okay, sales, all those will be recorded at the credit side.
Next, advantages of double entry system of bookkeeping. So first one, complete record of transaction. So in the double entry system of bookkeeping, if we compare with the single entry system of bookkeeping, we will get the complete record or complete transactions of all the activities, okay, that we can found in the double entry system of bookkeeping. But in the single entry system, yes, we are not going to get the complete transaction or complete record of transaction, we will not get. Okay, so that is the first advantage of double entry system of bookkeeping. Second one, accurate result. So why we will get the accurate result in the double entry system of bookkeeping means we are going to record all the transaction or all the activities it is related to money or monetary worth, okay, or cash and cash equivalent, okay. So for that we are going to record all the transaction, so we will get the accurate results also. So next, determination of statements. So once we done the statement, whether it may be income statement, profit and loss account, or financial statement. Okay, we can cross verify with this double entry system of bookkeeping. So which transaction we have started and what are the transaction we have recorded and which is the amount we have taken to the financial statement, that we can do the cross check. Okay, on that time we can easily determine the determination of the financial statements also, if any errors or frauds or mistakes are there. Okay, that is also one advantages of this double entry system of bookkeeping. Next, ascertain accurate profit and loss. Because in this double entry system of bookkeeping, everything will be there. Okay, from A to Z, all the activities from the day once the office is start till the close. Okay, they are going to record all the transaction or all the activities in the organization, so they cannot miss any transaction. Everything will be recorded, and with that help they can do the whatever the books of accounts, that is your journal entry, ledger account, trial balance, P&L account, financial statements, they can prepare and they can get the accurate profit or loss information. So next, prevention of fraud. In the single entry system, the finding the fraud or errors or mistaken is very hard to find. Why? Because they are going to miss some transaction. But when it comes to the double entry system of bookkeeping, they are going to record all the transaction. They are not going to miss even one transaction. Correct? So we can easily prevent the fraud also or errors also in the double entry system of bookkeeping. Next, better control and sound decision making. In the double entry system of bookkeeping, they can control over the all the activities. Why? Because they can check whatever the activities are happening in the organization for the past 1 month or quarterly basis or half yearly basis. They can check and they have the control over the transaction that will be there. And sound decision making. If anything is missing or it is out of control, then they can take the good decision making with that activities also. And the last advantages is comparison of results for the current year profit with the past year profit or the last year profit they can compare. Okay, with that they can estimate for the future also. Okay, that only possible through this double entry system of bookkeeping. Next, disadvantages of double entry system of bookkeeping. So first one, requires thorough accounting knowledge. Okay, for maintaining in a single entry system of bookkeeping, we don't require thorough accounting knowledge. Okay, just we have the mathematical knowledge, then we can easily do in the single entry system of bookkeeping. But if you want to maintain the books in the double entry system of bookkeeping, means yes, that person is required thorough accounting knowledge. Second one, only recording and maintaining the financial information. Yes, in this bookkeeping, that is in the double entry system of bookkeeping also, we are going to record the financial information. That's it. We are not going to analyze or we are not going to interpret or we are not going to compare with the any other things. Just we are going to prepare and the whoever the stakeholders will be there, they are going to compare or they are going to take the decision. Okay. Next, records the historical cost, not the present value or PV. PV stands for present value. Okay, so whatever the, for example, 1 year before we have purchased the plant and machinery, they are going to record that plant and machinery, whatever we have paid on that time, that price will be there, correct? But same value we are going to maintain in our balance sheet, but we are not going to maintain present value of the asset. Okay, whatever book value is there, only that book value we are going to maintain. That is also a one disadvantages of this double entry system of bookkeeping. We know present value, whatever rupee is valued today, that will be not same for the next day or after 1 week or after 1 month, correct? So that is the disadvantage here. And the last point, increase the volume of accounting work. In the single entry, just they are going to record and they are going to keep quiet. But here, it is not like that. They need to record in the double entry system of bookkeeping. That is, they need to pass the journal entry, ledger account, all these things they need to do in the double entry system of bookkeeping. So much of accounting work will be there. So these are the few disadvantages of double entry system of bookkeeping.
Next, methods of bookkeeping. So we have two types or two methods of bookkeeping are there. So first one, that is manual bookkeeping, and second one, computerized bookkeeping. So in the manual bookkeeping, yes, it is called as a traditional method of bookkeeping. And this computerized, we call it as modern method of bookkeeping. Okay. So in the traditional method, I think so you have seen the ledger books. One or the other way, you have seen the ledger book. So big books will be there, correct? So there we manually enter all the details or all the activities in the book. Okay, that is manual bookkeeping. And it comes to modern method, that is computerized bookkeeping. Here all the transaction will be recorded through the computers. Nowadays we have Tally. Okay, in Tally all your subsidiary books, okay, all your subsidiary books will be there. Easily we can record there only. So there is no need to record manually. So these are the two methods of bookkeeping are there.
Next, types of bookkeeping. So we already discussed methods of bookkeeping. So methods of bookkeeping, we have two methods. One is manual entry and second one computerized entry, or traditional method of entry and modern method of entry. So method is different, types of bookkeeping are different. Okay, so there are two different topics. So we'll see what are the different types of bookkeeping. Okay, so here broadly classified into two categories, that is one, single entry system of bookkeeping, and the second one, double entry system of bookkeeping. So we'll see what do you mean by the single entry system of bookkeeping and what do you mean by double entry system of bookkeeping with example. So single entry system, the word only tells you the single entry. There should be no two entries or two side effect. That is debit and credit is not there. Only single entry they are going to make. Usually the petty kirana shops, they are going to maintain this single entry system of bookkeeping. Okay, because the volume transactions are very less in numbers, correct? So they can easily maintain this single entry system of bookkeeping. If the volumes are more or number of transactions are more, then it is very difficult to maintain in the single entry system of bookkeeping. So on that situation, they will go for double entry system. Okay, so this is the brief introduction about the single entry system of bookkeeping. So we'll see the meaning. Under this system of bookkeeping, generally a cash book and books to be recorded, personal accounts are only maintained. Okay, so I have told you, right, in the large number of transactions are there, on that time it is not applicable. Okay, only with the less number of transactions are there, on that time it is implemented. So in that also they are going to record only cash inflow and cash outflow, that is in the cash book they are going to maintain, and any credit they are given. For example, for any customer they are given any credit, so on that time they are going to record in the personal accounts. So these are the two books they are going to maintain in the single entry system of bookkeeping. One is cash book and another one is personal book. It is not really a system because under this system there are maybe no record of transactions and only partial record of some others. So they are not going to record all the transaction. They are going to record at randomly. If for example 3 transactions will be happening in that petty shop, so including all the 3, they are going to take the total and they are going to record the amount. Or if they are given credit for any customer, that transaction they are going to record. Continuously they are not going to record. Okay, so partially they are going to record other transactions only. Why? Because they are given on the basis of credit, so they require how much credit they have given, correct? So for that purpose also they are going to maintain. Single entry system of bookkeeping is not perfect and frauds and mistakes can hardly be detected. Proper results cannot be obtained by its use. In the single entry system of bookkeeping, finding the frauds or mistakes or error, it is very hard to find. Why? Because they are not going to record all the transaction, correct? Partially they are going to record the transaction. In that, how can we find or how can we identify the errors in that transactions book? Okay, so it is very, very difficult to track the or errors and frauds in the books. proper results cannot be obtained by its use. Why? Because already we have discussed the meaning, correct? So in that meaning only they are given, only partial they are going to record, not completely, correct? So on that situation, proper results will not be getting. Okay. So for example, a single entry is made for all the income and expenses of a business for a month. Okay, for 1 month, they are going to record whatever the profits are there or whatever the incomes are there and whatever the expenses are there. Just they are going to record only that thing they are going to record. The balances of the income and expenses are carried forward to the next month. So whatever the profit is there for the month of January, they have spent the expenses of 10,000 and they have the revenue of 20,000 rupees. So 10,000 is the expenses, 20,000 is the revenue. So revenue minus expenses, it is your profit, correct? So 20,000 minus 10,000. So 10,000 is the profit amount. So that profit, what they are going to do? They are going to carry forward for the next month. That is for the February month, they are going to carry forward that 10,000 profit. And the next month starts with the previous month's total income and expenses balance. So whatever the previous month balance is there, that is January month, they are going to start with the same balances. That is the single entry system of bookkeeping. So next we'll see what you mean by double entry system of bookkeeping. The double entry system of bookkeeping can be defined as the system of recording transaction having two fundamental aspects. One is involved in the receiving of the benefit and the other to giving the benefit in the same books. That is, in the debit side, whatever the expenses are there, we are going to record, and the credit side, we are going to record whatever the losses are there in the ledger account. So next, we have two side effect in the double entry system of bookkeeping. One is debit and another one is credit. We have two side effect will be there. Okay. In that we are going to do all the bookkeeping. Okay. For example, purchase of plant and machinery and paid through cash rupees 10,000. Okay. So where is the two side effect? So plant and machinery comes to the business, correct? Asset is coming to the business. So for that, we are going to pay in the form of cash, 10,000. So plant and machinery comes to the business and cash is going out of the business. So these are the two side effect. One is asset coming and another side asset is going. That is cash is going out of the business. That is the two side effect. Okay. That is here also given debit and credit. So for each entry or for each transaction, in the double entry system of bookkeeping, we are going to record debit and credit. That is two side effect will be there. And there is no hard rule, only debit and credit. Okay. It may be debit and debit or credit and credit. That is also possible. Or vice versa. Credit and debit, debit and credit. Anything is possible. So next, accounting equation. Here in this, the medium level shops above the petty shops. Okay. What they are going to do? They are going to record all the transaction in the accounting equation form. Okay. For this also, no need to or no required the fundamentals of accounts. Okay. So easily they can record all the transactions in the accounting equation. Accounting equation is nothing but all the two side transaction they are going to record. Formula for accounting equation is capital is equal to assets minus liabilities. You will get the accounting equation. Okay. The mathematical equation form you will get. For example, journal entry. For double entry system of bookkeeping, one more example is journal entry. Format for journal entry is serial number or date, particulars, ledger folio, debit and credit. Okay, this is the format for journal entry. Same example I will take. Okay, purchase of plant and machinery for rupees 10,000 paid in the form of cash. So serial number 1 or whatever the date is there that we are going to record. Under the particulars, as per the real account rule, debit what comes in? That is plant and machinery comes to the business. So plant and machinery account, debit to cash account. Because cash is going out. As per the real account, debit what comes in, credit what goes out. So what is going out? Cash is going out of the business. So to cash account. So plant and machinery account, debit side 10,000 and To cash account, credit side 10,000. So this is the example of double entry system of bookkeeping.
Next, difference between bookkeeping and accounting. So here we'll see what is the difference between the bookkeeping and what are the difference of accounting is there. Okay. So first one, to prepare original books of accounts. So in the bookkeeping, yes, all the primary entries will be done in the bookkeeping only, correct? So from that bookkeeping entries only, we need to start with the accounting, correct? So in the accounting, once we get the primary entries from the bookkeeping, then we are going to proceed with the record, analyze and interpret business transaction. That is our journal entry. Okay, recording, summarizing, analyzing, that we are going to do in the accounting. So next, recording the business transaction, that is monetary or monetary's worth or money's worth. That business transaction we are going to record in the bookkeeping. When it comes to accounting, it is having the wider scope. Okay, it is only limited to the business transaction. But when it comes to accounting, it has the wide scope in the market. Next point, clerical works involved in it. So in the bookkeeping, it's nothing but all the clerical work because we need to record all the transaction, correct? So clerical work will be involved. So when it comes to accounting, it has concerned with the low level, medium level and even top level management works will be there. So here only clerical work, here we have all the hierarchy level will be there in the accounting. So next, it's dependent on accounting, which mean it meaningful and purposeful. So without this bookkeeping or recording the transaction, we cannot go with the further, correct? So with this bookkeeping transactions only, we can prepare the journal, ledger, trial balance and other things. So this is the meaningful and the purposeful. When it comes to accounting, accounting is based upon the bookkeeping, which is initially and vital part. Okay. So after this only, we need to receive or we need to record all the other transaction in the accounting. So next, under the bookkeeping, it does not show the net result of financial position. Why? Because we are not going to prepare any books of accounts. Just we are going to record the transaction. Correct? So we are not going to prepare or we are not going to analyze any transaction here. So while it comes to accounting, it shows the net results of the business. Why? Because we are going to prepare all the financial statement and then we are going to analyze and then interpreting the results. So we will get the net results in the accounting. Next, for bookkeeping, accounting concepts and conventions are followed while recording the transaction. Okay, we have 9 accounting concepts and 4 accounting conventions are there that they are going to follow, and then only they are going to record the all the transaction in the bookkeeping. While it comes to accounting, method of reporting and interpretation may be vary from firm to firm, because if it is sole trading concern or sole proprietorship, okay, or partnership, MNC company, IT company, okay, they are following their own ways of the book of accounts.
Next, summary. Here we can recap whatever we have discussed in this session. Here we have discussed introduction to bookkeeping. So what is the general meaning of this bookkeeping and why they are going to maintain, or what is the example for bookkeeping that we have discussed in the first. Okay. So next, meaning and definition we have discussed, correct? So what is the meaning of bookkeeping? That is, it is the art of recording business transaction in the books of accounts in an ordinarily manner. So that is the meaning of bookkeeping. Okay. So they need to maintain all the books or all the transaction in the books of accounts. And we have discussed what are the process or whatever the process involved in the bookkeeping. That also we have discussed. Next, we have discussed objectives of bookkeeping. There are few objectives are there, but we have taken only 3 objectives of bookkeeping. Next, that is elements of bookkeeping and accountancy. Here we have three main elements of bookkeeping. That is one books, second one is ledgers, and third one is trial balance. So in the books we have different 8 books of accounts are there. Okay, that is cash book, purchase book, sales book, purchase return book, sales return books, bills receivables, bills payable books, and journal proper. These are the 8 different books are there. And next, ledger. Okay, what is the format of ledger that we have discussed, meaning of ledger we have discussed, and trial balance. Okay, the format of trial balance also we have discussed. Next, methods of bookkeeping. So we have two different types of or two different methods of bookkeepings are there. That is first one, manual bookkeeping and computerized bookkeeping. That is traditional method and modern method is there. Next, we have discussed difference between bookkeeping and accounting. So what are the differences of or major differences between the bookkeeping and accounting? Next, types of bookkeeping. So we have two types of bookkeeping, that is single entry system of bookkeeping and double entry system of bookkeeping. And we have discussed what is the meaning of single entry system of bookkeeping and which are the books they are going to maintain in the bookkeeping. That is in the single entry system of bookkeeping they are going to record. All those we have discussed. Next, double entry system of bookkeeping. So in this double entry system of bookkeeping, we have discussed the meaning and what do you mean by debit and credit and what is the accounting equation and format for journal entry also we have discussed. Next, we have discussed advantages of double entry system of bookkeeping. So here we have 7 advantages of bookkeeping, that is double entry system of bookkeeping that we have discussed. And next, we have discussed disadvantages of double entry system of bookkeeping. There are 4 disadvantages that is also we have discussed.
Management accounting is the provision of financial and non-financial decision-making information to the managers. In management accounting or managerial accounting, managers use the provisions of accounting informations to inform themselves better before they decide matters within their organization, which allows them to manage better and perform and control functions more efficiently. Now, with that note, I am Edwin Thomas, and let's get started with the course on Introduction to Management Accounting. So now let's talk about the topics that we are going to cover in today's course. So before we directly jump into our main topic, that is management accounting, we'll have first a small discussion on the basics of accounting. Under this topic, we'll be discussing the accounting process and the 5 elements of financial statements. So by understanding and clearly learning about these topics, you will have a firm grip on the basics of accounting and you can easily segue into our main topic, that is management accounting. Now, under the topic of what is management accounting, we will be discussing the definition of management accounting and also understand what is management accounting. Then, to make things even more clear, we have the next topic, that is characteristics or the nature of management accounting, where you will have even more clear idea of what management accounting is. Now, if you want to pursue a career in management accounting, you will actually want to know what kinds of shoes you're going into, right? So for that, for making that clear, we have the role of management accountant, that is the next topic, where we will be actually making you clear what kinds of roles and responsibilities will be given to you if you are going to enter into a company as a management accountant. The next 2 topics is the difference between management and financial accounting and the difference between management accounting and cost accounting. So there are a lot of confusion between like financial accounting, cost accounting and management accounting is the same thing. What is the big difference? So these 2 topics are going to bust the confusions that are coming across between these 3 domains. So we'll be differentiating between management accounting, financial accounting and cost accounting individually. Then, to conclude things, we have taken a real-time example of a management accountant working in a manufacturing company and what kind of role was he assigned to by the upper management and how does he resolve it. So that is the way we are going to conclude this course. Hope you guys are going to stay till the end of the course to understand what is the kind of roles and responsibilities of management accounting. All right, guys. So now, before we enter into our major topic, that is management accounting, let's brush up our fundamentals, that is the fundamentals on basics of accounting. Now, accounting is basically summarizing financial data into a meaningful format. Now, every company has a huge amount of financial data that is getting generated on a daily basis. For example, the bills, the vouchers, the receipts, etc. Now, in accounting, all these transactions are recorded, and not only that, these transactions are actually recorded, and management accountant actually classifies these and also summarizes these into meaningful format. Now, all these things are done actually to answer the questions about the financial stability of the company to the owners, to the shareholders, or as a matter of fact, even the government of India. So that's why accounting is so much important to a company. Now let's talk about the accounting process. Now the flow of the accounting process is on your screens. Now first comes the source document, followed by the journal entry, ledger, trial balance, and financial statements. Now the first four process is altogether known as bookkeeping. Now let's first take up source document. Now, to record any financial transaction, you need to have an evidence of that transaction. So, evidence can be a bill, a voucher, or an invoice, or any evidence that is pertaining to a financial transaction. So, any evidence that is pertaining to a financial transaction is known as the source document. Now, coming to the second process, that is journal entry. Now, according to the source document, an entry is made inside the journal book. Now, a journal entry consists of the date of the transactions, the particulars like the description of the transaction, the credit column, and the debit column. Now, a financial transaction is entered inside the journal book according to the classifications. Now, coming to the third flow in the accounting process, that is ledgering. Now, let's understand what is a ledger. A ledger is a book that consists of a bunch of T accounts, and these accounts are known as T accounts because when we form a T, you can see that there is two columns that is getting formed. Now, always remember, the left side of the column is always known as the debit column and the right side is known as the credit column. Now, a ledger account or a ledger book is divided into three, that is general ledger, debitors ledger, and the creditors ledger. Now, a general ledger consists of an overall sales figure, and a debitors ledger is known as the T accounts for the customers. Now, for example, Rohan is your customer. He buys goods from you on a credit basis. So basically, he buys goods from you and does not pay, and he says that he will be paying in the future. That is what is known as credit basis. Now, understand that since Rohit actually owes monies to the company, the account goes to the debitors account. So T account is made in the name of Rohan. So now if your official goes and buys something from your suppliers and buys the goods on a credit basis, that is, you take the goods but does not pay the company now, but you promise to pay them in the future. So that is known as credit basis. Now, but you owe you as a company owe the suppliers the money. So these kind of transaction goes into the creditors account. So that's why it is known as T accounts for the suppliers. So now you have understood the ledger are divided into general ledger, the debitors ledgers, and creditors ledger. Now, ledger is the place where all the individual transaction is getting summarized. Okay, so now a journal book actually has a ton loads of transactions that is coming on a daily basis from our customers and also the suppliers. Now, think of a situation like if your manager comes to you and asks you how much money do we owe Rohit's company for their dues. So now and when your manager asks you this, you can't just go to your journal books and search for the transactions that Rohit's company made, because Rohit's company might have made transaction on 15th of August, 20th of August, 24th of August on different various dates. Now you can't go sit there with the journal book, gather all the transaction on a daily basis, and then start calculating and then understand how much money do we owe them. So instead of that's where ledger actually comes into play. So when you actually add a transaction into a journal book, there are T accounts on Rohit's name already. So when a transaction is entered into the journal book, it is also getting transferred to the ledger. Now this process of transferring the debit and credit to the ledger is known as posting. Okay, so that's the technical term that is used for the transfer process from a journal entry to a ledger. Now, as we are actually transferring this data, you actually get a proper one figure for the transaction of a T account in the name of Rohit. So the next time when your manager comes to you and asks you how much money do we owe them or how much money do they have to pay us, you will always have one figure that is 50,000 or 5 lakhs that they owe us or we have to pay them. So that's why ledger is so very important to actually answer the direct questions that comes to you. Now, after we are done with the ledger accounts, we move ahead with the trial balances. Now, trial balances basically is to balance all the general ledger account of a company in a certain point of time, mostly in the end of the year. Now, the basic objective of a trial balance is to summarize the ledger accounts. The second major objective of the trial balance is to create a base for the financial statements. Now, as I mentioned earlier, the four processes, that is the source document, journal entry, ledger, and trial balances, are all together known as bookkeeping. Now, after the process of bookkeeping is done, is when where we move ahead with the financial statements. So the financial statements are divided into three, that is balance sheet account, profit and loss account, trading account. So now that's the entire process of accounting process. Now I believe that you have understood the flow of process of accounting. Now let's move ahead with the next topic. So next up, we have the 5 elements of financial statements that are expense, assets, liability, equity, and revenue. Now let's understand each of them individually with their definitions. Now coming to assets. Assets is a resource controlled by an entity. Now, what do you mean by control? Control is like an ownership. An entity can be a single person or an organization. So asset is a resource controlled by an entity as a result of past events and from which future economic benefit is expected to flow to the entity or the organization. So what do you mean by future economic benefits? Now, for example, you have a manufacturing company and you bought a machinery. Now, that machinery is an asset because that machinery is going to actually provide you with future economic benefits because it's going to provide the raw material to convert into finished goods, right? So that is exactly how an asset is defined. Now, coming to expense. An expense is the cost of operations that a company incurs to generate revenue from which no further benefit is expected. Now, difference between an asset and expense is that in asset there is future economic benefit, but in an expense there is no future economic benefit. Now, an example of an expense is like the rent that you're paying for the stall or the shop, or the electricity that you're paying, or the salaries that you're paying to your employees. So that is the kind of expense which will not have a future economic benefit. Now, coming to the next point, that is liability. A present obligation of the entity to transfer an economic resource as a result of a past event. It is a claim of an outsider on the total asset of the company. Now, for example, if you have a big loan that you have taken from a bank, that's actually acting as a liability because you have to repay it. That's why it's called as the claim of outsiders on the total asset of the company. Now, coming to the next point, that is equity. Now, equity can also be known as capital. So, according to the organization, if it's a partnership organization where there are few owners, it's known as capital that has been put by the owners. If it's a capital put by a number of people like A, B, C, D, A is capital, B is capital, C is capital, and D is capital. But when it's a company, it becomes equity because the company has a lot of owners that is in the name of shareholders. So that's why it's known as equity. But the definition of both capital and equity is going to be same. Now, it is the residual interest in total asset of the entity after deducting all its liabilities, and it is the claim of the owners in the total assets. So now equity is the residual interest, that is after the payment of the liabilities, the residual interest is known as the equity, and it is the claim of the owners, as I mentioned earlier, the owners or the shareholders. Now, revenue. Revenue, it is the gross inflow of cash, receivables, or other considerations arising in the course of ordinary activities of business, such as the sale of good, rendering of services, etc. In simple words, if I had to say what is revenue, it's income. So that's the easiest and the most simple word to explain revenue. Now, with that, we have completed the basics of accounting, and let's move ahead with our craziest goal, that is management accounting. All right, guys. So now that we have covered the basics of accounting, now let's move to our major topic, that is what is management accounting. Now, management accounting has various definitions given by the Chartered Institute of London, Chartered Institute of England and Wales, and many other professors. Now, let us stick to the definition that was given by the Institute of Chartered Accountants of India, that is ICAI, and that goes by the techniques and procedures by which accounting mainly seeks to aid the management collectively in making decisions have come to be known as management accounting. Now, after reading the definition, you might have understood that management accounting is done to help the upper management in making decisions of the future by formulating plans and growth options by using quantitative and qualitative analysis. So that's what is management accounting for you. So now, to understand management accounting even more clearly, let's move ahead with the next topic, that is characteristics or nature of management accounting. Now, here, the first point we have, management accounting is a technique of selective nature. Now, why is management accounting known as a technique of selective nature? That's because in management accounting, the accountant does not require all the data that is provided in a financial record. Now, in a financial record, it might contain the financial statements, the balance sheets, the profit and loss statement, the cash flow statement, the income statements, and a lot more information. So, for example, a management accountant only requires the balance sheet and the profit and loss statements to actually do his quantitative and qualitative analysis and actually provide a report to the upper management. And so, due to this selective nature of management accounting, that using only these two statements to arrive at a conclusion, that's why the technique is known as selective in nature. Now, coming to the second point, that is management accounting is concerned with the future. Now, every company in the start actually accomplishes some goals, and then it always actually thinks about what is the future of the company, what are the future plans that could actually impact the company's growth. Now, here's where management accounting actually helps. So management accounting actually does the analysis and helps the upper management takes a decision. Because of its quantitative and qualitative analysis, it can actually forecast the different options that the company can go further. So the different options, and with their liabilities and their debts and their profit benefits, all these kinds of information are given to the upper management in the form of a report, which helps the upper management to actually go ahead and choose the right decision for the company's growth. And this is why management accountant is always concerned with the future. Now, coming to the third point, that is management accounting makes available useful information. So now, by hearing the term management, you might be in a confusion that management accountant might be into the level of decision making, but that is not the exact concept. So management accounting basically only provides the necessary information to the upper management to make the decision making. The decision making is entirely up to the upper body or the upper management, and only the information or the report that is provided by the management accountant is actually used for the decision making process. So a management accountant is not actually the person who takes up the decision. It is the upper management who takes up the decision about the company's future. So that's one thing that you have to make it very clear. Now, coming to the fourth point, that is management accounting attempts to study the cause and effect. Now, in financial accounting, they basically deal with the analysis of the profit and loss statements. Now, in management accounting, they try to or attempt to study the cause and effect relationship that actually impacts the profit and the profitability of the business. Now, coming to the fifth point, that is, management accounting is no bound by rules of financial accounting. Now, unlike cost accounting or financial accounting, they are actually bounded by rules that is provided by ICAI, that is Institute of Chartered Accountants of India. So, unlike these two, management accounting is not bound by legal rules. Management accountants are just have to follow the company policies they are working with, and they have to follow the instructions that is given by the upper management. So that is the fifth point that explains you management accountant is no bound by the rules of financial accounting. So if you want to pursue a career in management accounting, you would always be curious to know what is the kind of role or what is the kind of responsibility that you will have on yourself as a management accountant of a company, right? So that's exactly what we are going to discuss here. Now, here we are going to discuss what are the kinds of roles that, as a management accountant of a company, you will have to work upon. So, these are the points or the roles that given below, which you will be working on maximum amount of time at that company by doing the following things. So, the first point that is mentioned here is the collection of information. So, as a management accountant, he collects the essential data that is from a financial record to formulate his plans and policies to the management. So basically, as we already discussed, in a financial record, there are a lot of statements that like the profit or loss statement, the income statement, the balance sheet, etc. So the as a management accountant, he only chooses the relevant information and collects it, and then formulates a plan accordingly to the management. So that's the first step that as a management accountant does. Now, coming to the second point, that is evaluation of information. So, here comes the role of evaluation, wherein the information that is collected in the first role that is getting evaluated for the best purpose, that is the usage, best usage, and easy understanding, right? So, here the management accountant becomes the judge of keeping what is relevant and what is irrelevant. So, he keeps what is relevant to the report that is going to be presenting to the upper management. So that is the second point, that is evaluation of information. Now coming to the third point, that is analysis and the interpretation of data. Now the accounting data is meaningfully analyzed, and that is for the effective planning and the decision making. Now the data is represented in a very comparative form, that is the ratios are calculated and the effective likely trends are projected to the upper management. Now coming to the fourth point, that is planning and organizing. A management accountant assists the management in planning as well as formulating policies. Now, this is done by forecasting the production, selling, inflow, and outflow of cash. Now, a management accountant also shows the alternate course of action and forecasts this also. Now, coming to organizing, a management accountant organizes by preparing the budget and delegates the responsibility for the proper utilization. That's how the management accountant has the role of planning and organizing. Now, coming to the next role, that is reporting. Now, reporting is one of the main role of a management accountant because he has to report everything that he has found, that is his analysis, the data, the plan, the policies that he has formulated. He should be actually representing these all data that he has found in a very structured and clear manner and an articulate manner to the upper management, so that it can be easily understood and easily read by the upper management to make their important decisions for the company in the future plans. So reporting is actually a very important role for a management accountant, and he has to do this reporting as perfectly as possible. Now coming to the last point, that is coordination and decision making. Now, a management accountant helps the management in coordination with the enterprise by preparing the budget and forecasting the future plan and helping the management in taking future decisions. So, by that, now you have got a clear idea of what are the kinds of roles that a management accountant is supposed to be doing in a company. So if you are all good at these kind of roles, you will be a really good management accountant. So now that you have understood the roles or the responsibilities or the kind of work that the management accountant is supposed to do, now we are going to understand the difference between management accounting and financial accounting. Now, we are having this topic because many people have a different assumption that management accounting, financial accounting, and cost accounting are the same thing, just a few small differences. So, now we are going to bust these confusions between the people to understand what are the clear differences between management accounting and financial accounting. So now here I have actually made the differences based on a certain categories. So I have made differences based on the users, the objective, the event focus, the legal slash the rules, the information, planning and control. So now the first column on the right is the management accounting and the second one is the financial accounting. Now let's start off with the differences between each of them. Now, based on the users, management accounting, it's showing internal, and financial accounting, it's showing internal and external. Now, we are going to be differentiating these two parallelly, okay? So, internal users means that the management accountant actually reports to the internal management or the owners of the company, right? And these reports or the data or financial data or the quantitative and qualitative data that is being done by the management accountant is actually used by the internal committee of inside the company, and it's not published in any website to for the investors or something like that. So it's all the data that is done, all the analysis, the data or the forecasting done by a management accountant stays internally inside the company. Now, talking about financial accounting, the financial accountants, all the data like the financial statements, whatever data that is being done or created by the financial accountant is actually used by both internal users and external users. So basically, internal users remains the same. The internal committee, the owners or the management, upper management, people above sitting in the hierarchy, above in the hierarchy. Now, external. What do you mean by external users? So external users are the investors or the people who are willing to invest into companies. So on what basis are they going to invest? So these investors will actually look into the balance sheet, the financial records of the company to actually understand whether this company is financially stable, whether this is a debt making company, whether the company's fundamentals are strong, or whether they are making losses this year or this quarter. So that's how the reports or the financial data provided by a financial accountant is both used internally and externally. So now that you have understood the difference of management accounting and financial accounting based on users, now let's move on to the next point, that is the objective. Now, the objective under management accounting is written as assisting the internal management, and the financial accounting is written as assisting the internal and external decision makers. So, it is the same, almost same as the users. So basically, the users, as we told, is the internal management, right? So whatever, as a investor's perspective, if you actually are a good investor, you must understand that a good investor must actually think about the future of the company, right? So if he is new to investment, he must be thinking that why is a company wasting money on a management accountant and paying a lot of money to him. But if you are a really good investor, you must be actually grateful to the company that the company is actually having a management accountant which is actually helping the management in assisting the future plans of the company, right? So the objective is assisting the internal management. So a management accountant actually forecasts different kinds of data which actually helps the management to make future decisions regarding the future expansions, etc. And the management accountant also show alternate course of action, what are the benefits of this course of action and what are the benefits in this, what are the pros and cons of each course of action which they choose. So that's how the management accountant is assisting the internal management. Now, assisting internal and external decision makers. Now, financial accounting, the financial data is provided to internal management, and it's always a quantitative way of presenting the data. Now, the external decision makers are the investors. So basically, by providing the financial data, statements of the company, the external decision makers are the investors who would like to invest in this company, looking into the financial, because the balance sheet of a company is a very promising piece of paper that actually helps the company, or the hence the investor, understand the company is doing well, and in a long term basis he is going to provide a lot of profits and returns to the investor. So that's how it assists the external decision makers to actually invest in this company or not. Now, coming to the third different point of focus, that is event focus. So, in management accounting, it is written the future and present events, and in financial accounting, it's written past events. So, what do you mean by event focus? So, based on event focus, I meant that the management accountant basically works for the future expansion or future planning of the company, right? And the financial accountant actually works on the past events or the past records or the transactions that has already happened, and what is the condition of the company now, right? So that is what I meant by event focus. So a management accountant actually forecasts the budget, forecasts then formulates the planning by actually understanding how much financially stable we are, and what are the course of financial expansions that a company can take in the future. So his observation is towards the future, and a financial accountant is basically working on the past events. So all the works he does is based on the past that has already taken place. So whatever transaction that is taken place, he's doing the accounting, and then the all balance sheet and credit trial balance and credit and balance should be equal, all these kinds of things, and the financial statements, the balance trading account, the balance sheet, all this is the past account, right? So that is what I meant by event focus. So this is a major difference, because management accountant is future and present oriented, and financial accountant is past oriented. Now coming to the fourth point, that is legal slash rules. Now under management accounting, adhere to the rules under the management and adhere to the rules under the financial body. The financial body here is ICAI, that is Institute of Chartered Accountants of India. Now, adhere to the under the rules of management. So, management accounting is not actually should not follow any rules that is under ICAI, because he is actually working under the management, and he must just follow the rules that is full rules and instructions that is actually given by the company or the upper management. Now coming to financial accounting, there is always a financial body in that country that actually puts up the rules that must be followed in the financial accountings. So the financial account must always obey and abide by the rules in while making the financial data. Now coming to the information. Now management accountant actually provides both quantitative and qualitative information to the management, and financial accounting is always quantitative. Now financial accounting, from the past data, it actually finds out the quantitative measures, how much amount, profit and loss, the income, revenue, all these kinds are quantitative measures, and understands how well the company is doing in the measures of numbers, right? So we can understand how much loss or how much profit is the company making. Now this data is actually used by the management accountant, and he finds the quantitative measure with his quantitative analysis. Now, after this quantitative analysis, he does a qualitative analysis about the forecasting or the formulation of plans, and then he works on how much of amount that will be actually required for the expansion or the course of action into new businesses, right, for the company. So that's the qualitative analysis that the management accounting does. So that's one major difference, that management accounting works only on quantitative, management accounting works on both quantitative and qualitative, and financial accounting works on only quantitative data. Now coming to the last difference, that is planning and control. Okay, so under management accounting it's written managerial decision making, and under financial accounting it's written as investment decisions. So what is the perfect difference in this is that management accountant actually makes it very easy for the management to make decision about the future expansion. That is what is actually meant for planning and control, that the management accountant assists the planning and the control of the decisions that is going to be taken inside the upper hierarchy of people who takes the decision for the company. So that's how the managerial decision making comes into play. Now, investment decisions, as I told you, the investors actually look into the financial data that has been published on the websites of the company regarding their financial stability, and then these decisions are actually made on the financial reports that is being published. So that's why the planning and controlling in this case is given to the investments or investors. So that's why it is written as investment decisions. So the planning and control goes to the investment decisions. So now that you have understood clearly based on the different categories that I have given to you, you might have understood what are the differences actually that comes into play while talking about management accounting and financial accounting. All right, guys. So now that we had a clear differentiation between management accounting and financial accounting, now we are going to remove all the confusions between the differences of management accounting and cost accounting. Now, you might hear some similar points that I'll be telling about management accounting, which were discussed earlier, but there are the difference on the category of difference that I have made here is a little bit different because I have made the differences based on objective, nature, guiding principle, legal slash rules, and the data used. Okay, so let's start off the differences between these two. So, starting with this, the objective. Now, under management accounting, it's written like providing information for planning, controlling, and decision making. And under cost accounting, it's written to determine the cost of production. Now, management accounting is done because providing informations for planning, controlling, and decision making, because a management accountant actually creates reports and assists and formulates or forecasts the different plans that is going to help the inner or upper hierarchy of management to make the decisions for the future expansion of the company. So that's how the management accountant creates the reports to the internal managements, and thereby fulfilling the objective of planning, controlling, and decision making. Now, talking about the cost accounting, it's basically accounts to determine the cost of production. So, if you are actually creating a product, there will be a cost that is coming from the raw materials, then the cost of operations, the cost of production. So, these are the kinds of costs that will be actually accumulating and finally determining the cost of production of that product. So, that's what actually cost accounting does. Now, coming to the second point, that is nature. So, the nature of management accounting is basically into planning and decision making on future programs. So, as we discussed earlier, the management accountant is basically future oriented. And when coming to cost accounting, similarly to financial accounting, it is based on the past performances or records or transactions and present financial figures. So that's the kind of nature that the management accountant works accounting does, and the nature the cost accounting is. Now, coming to the guiding principle. So there is no general principle that is coming for the management accounting, but there is a principle of cost concept that comes into cost accounting. Now, coming to legal rules. So, as earlier, management accounting is adhered to the rules under the management or the rules or policies or company policies that he's working in. But cost accounting is adhered to the rules of the financial body. For example, in India, it's ICAI, that is Institute of Chartered Accountants of India. So that is the kinds of rules that the cost accounting is adhered to. Now, coming to the data use. Now, the data used by management accounting can be both quantitative and qualitative, but cost accounting is purely quantitative aspect of, because in data use, or it can also be information that is provided by management accounting is both quantitative and qualitative. He works upon quantitative and qualitative data and also provides quantitative and qualitative data that we discussed in earlier difference. Now, here regarding the cost accounting, it's always the quantitative aspect, because it's always the number, the cost of production, the cost, the debt, everything is the amount of money that is being spent, right? So it's always the quantitative aspect that is getting talked in the cost accounting. So by that, now you have understood what are the clear differences between management accounting and cost accounting. And earlier we discussed about the management accounting and financial accounting. So now you might have a clear idea and the differences between all these three. All right, guys. So now that you have understood the differences in the accounting terms that were discussed, let us discuss real-time example and come to know the approach of a managerial accountant in the company. So now Rohan is the CFO of a manufacturing company, and the company's controllers has asked him to submit a quarterly review. Now here what we have to understand is the approach that he has taken. So Rohan, as the CFO of the company, actually is obliged to put in management accounting report to the upper hierarchy. So the first and foremost thing that he did to in his report was adding the company's financial to the report. Now that was not difficult for Rohan as there was a precedent on that. Now, coming to the next important decision that Rohan must choose is that the important variables. Now, since he was in line with the business areas that the company was following, he must choose the right business variable onto his report. Now, the two different business operations that the company was working on was the online commerce and a very big, large client that recently signed. So now Rohan, instead of adding the analysis of the website or the deals that were taken place with this big client, he actually put down the operations that actually affected the company's finances. And then he submitted this report. So he only used that report that which had an impact on the company's finances with new business operations into his report and finally submitted to the board of directors. Now, when the meeting with the board of directors came in, the board of directors actually loved the report that was presented by Rohan to them because it was clearly mentioning what are the effect of these two new business operations that is taking place on the company's finances, and they, on as a matter of fact, they actually put on other resources. They allocate other resources to find out answers to the questions that was not related to finance. So this is how the approach of a management accountant actually plays an important role in the company. So now that you have understood this approach from the case study that I have been given to you, now you must understand what kind of approach must be taken as to pursue a career in management accounting. Now let's move ahead with the next topic where we'll be discussing what are the kinds of topics or the subjects that were discussed. That is the summary.
Before moving on, let's talk about our learning objectives. So we'll be starting with knowing what is financial accounting, what is the need of financial accounting. Then we'll know about the three main financial statements called the balance sheet, income statement, and cash flow statement. So we'll be discussing in depth what are the various components of it and what is the uses of all three statements. At the end, we'll be discussing about the various financial ratios that we look at when we analyze different companies and their performance, how well they are doing, how stable they are, what are their growth perspectives. So we'll look at that in the module of financial ratios. What is financial accounting? So as the name suggests, financial accounting is something that is related to finance or money, right? So it is basically the recording, summarizing, and analyzing of various business transactions that are happening in a company on a day-to-day basis. So all these business transactions are then noted down and used to create three major documents called the balance sheet, income statement, and cash flow statement, togetherly known as the financial statements. Now, these financial statements are utilized by both the internal stakeholders and external stakeholders of the company. Internal stakeholders would include the top management of the company, and external stakeholders would include the retail investors or the common people who would wish to invest in the company through stock markets. Now, these statements would provide an accurate view of the financial health of the company, whether the company is in profit or is in loss, whether the company has accumulated too much debt and liabilities in its side, or does it have surplus amounts that it would give out as dividends. So all these things have to be documented in these financial statements. Before talking about these financial statements in depth, let's talk about basic terms and terminologies that are used in the accounting world. So there are mainly 5 types of accounting terminologies, one being asset, liability, revenue, equity, and expenses. So let's look at what is an asset. Now, asset is a resource that drive future economic benefit to a company or an organization. So it consists of cash, office equipments, machinery, land, property, and investments. It can be a short term investment or a long term investment. All of it comes under asset because it drives certain value for the company in the coming years forward. So not all assets are visible to us. There are some which are intangible, like patents, intellectual property rights, trademarks, etc. Some of them are tangible, like cash, land, property, machinery, etc. Next is liability. Liabilities would be of 2 types basically. Short term liability would include short term debts. Long term liability would include long term mortgages, long term bank loans, etc. Next comes equity. Equity is the amount of capital that is owned by the promoter of the company. It tells us about the ownership of a company or a business entity. What you see is known as an accounting equation. It is known as equity equal to assets minus liability, or in the other terms, asset equal to liabilities plus equity. Okay, so let me show this with an example. Let's say that you are buying a truck for your company for your logisticals needs. You're buying a truck worth 1 crore. Okay, but you only have 20 lakh in hand with you, and the rest 80 lakh you take a bank loan, right? So in this case, that the 20 lakhs that you have in your hand is called your equity, and the 80 lakh that the loan that you have taken is called liability because you have to give it back, right? And the 1 crore that you have is called an asset because it would drive a future economic benefit when you use this truck in the logistical needs or to get raw materials or to deliver products. This would drive a economic value in the future, right? So this is asset. Now if you subtract equity equal to asset minus liability, if you subtract the assets of 1 crore minus 80 lakh, you would get 20 lakh as equity, right? So this right here is also called as the accounting equation, right? Which is very important to know. Next is revenue. Revenue is the amount that is generated by the company from its core operations by selling a product or a service in a given period of time. So the point to be noted here is that revenue is not the profit or a loss of a company. Revenue is the selling price of a particular service or a product. Let's say that you are selling samosas of 20 rupees each. So that 20 rupee that you are selling would be your revenue, because we haven't subtracted any cost that is incurred from it. So it is the total amount. Next is expense. Expense is the cost that is incurred in the development of a particular product or a service. Now, expense would not have any future benefits, right? Now, if we subtract an expense from the revenue, we get net income. Net income is basically if the product is in profit or loss. Let's take an example. Let's say that you are selling tea that is of 10 rupees. Now, this 10 rupees is your revenue, as this is your selling price, right? Now, making of tea, the cost would be milk, let's say of 2 rupees, sugar, 1 rupee, and tea leaves, that would be of 2 rupees again. So the total making cost would be 5 rupees, right? So this part would be your expense for making that particular product. Now, if you subtract these two, subtracting 5 from 10, you would get 5 rupees. That is your net income. So it is profit, since the expense is less than the revenue, you get profit. If the expense is greater than the revenue, then you would have a loss. If the expense is less than the revenue, then you would have a profit, right? Next, we'll be talking about the two methods of recording transactions, that is accrual based of accounting or cash based accounting. Now we'll know the difference between the two coming forward. So first we'll start with cash accounting. So cash accounting is a method of recording transactions in which the entries are made only when the cash has exchanged hands between two parties. So the revenue is entered and the expense is noted only and only when the cash has been received or paid out. So let's say that you are purchasing a raw materials for your business. So the day on which you give out the payments as cash will be recorded in the expense account. Secondly, when you make the sale of those products, on the day you receive that cash from the particular customer, then the entry will be made in the revenue account. Okay, let's take an example. Let's say that you are a retail phone seller. So for that, you would need to first purchase the phone from the company and then sell it to the seller, right? So first step would be to purchase the phone from the company. Let's say you paid 15,000 rupees, okay, to get that phone on 20th, let's say December, okay. Then you would sell that particular phone for 20,000 rupees on, let's say, 29th of December. Okay, and the cash you will receive of that particular phone, let's say 2-3 days later on 1st Jan. Okay, 1st Jan is when you receive the cash. Okay, now what cash based accounting states that you will make the entries only on the day you have either paid out the cash or received the cash. In the case of expense of 15,000 that you purchased from the company, you will make the entry on 20th December because you have paid out cash on that particular day. After selling that particular phone for 20,000, you will make that entry on 1st January and not 29th December because you have received the cash on 1st January. Now you have to look at the December account. So in December account, you have paid the money to a company, right? To the phone manufacturing company. So that will show me a loss of 15,000 as the money has went out of you. Similarly, in case of January account, since the entry is made in January, so in January account, it would show me a profit of 20,000. Now, this is not a correct picture of a financial health of a company as in two different months in a particular time in history. So it is giving me an unrealistic example of how things are going. Now we'll know the disadvantages of cash accounting. As mentioned before, that it is not accurate to identify the financial position of a particular company in a given period of time. Second, it is not recognized by both GAAP and IFRS. Now, what is GAAP? GAAP is General Accepted Accounting Principles. So, second is IFRS. It is International Financial Reporting Standards. So, both of them discourage the use of cash accounting because it does not give a very good picture of how the company is doing. So no big company uses it. So if you have a very small business like selling of tea or selling of samosas, then this would work out, but not on the scale in which you have lot of products and service to be delivered in the coming months that would have a deferred revenue. Next comes, there are a lot of loopholes since it is a very vague standard in which you will only account it when something is received or when something is gone out. So it would involve a lot of unfair practices, which is why it is discouraged. Next up is accrual accounting. So in accrual based of recording transactions, what exactly happens is the revenue is noted down when it is earned and the expense is noted down when the expense has incurred. What does that mean? So for example, that you are selling a bulk order of 35 of particular product. So on the day of that particular order, you will be writing it down in your revenues account on that time. The payment of the clients can come later, that's not an issue, but on the day in which the order has been placed, on that day it will be marked in your revenue account. Similarly, when you buy your raw materials, so on the day when you have made that purchase of the raw materials, on that day it will be marked in the expense account. So the bills of those raw materials can be paid later. So in the previous example, what we noticed in cash accounting was that on 20th December, when you purchased the phone from the manufacturing company and you sold it on 29th December with the payment by the customer being done on 1st January. So 1st January was noted down, right? But in this case, in accrual type of accounting, the entry into the revenue part would be done on 29th December itself. So what would happen is, in the December account, there would be an expense of 15,000 on 20th December, and there will be a revenue of 20,000 on 29th December. So this is the difference between the two, cash accounting and accrual accounting. Now in this case, if you would know what is the profit that you would earn, that is revenue minus expense. So revenue, if I subtract expense from revenue, it will be 5,000 rupees. So this would be the profit in December account. Now this would give a good and accurate picture of how the company is going in that particular month, right? So that is why accrual based accounting is preferred over cash based accounting. We'll look at some of the advantages of accrual accounting. So in this case, first, it gives a very good picture of how the financial situation or financial health of the company is. Secondly, it works on all the standard principles like Financial Accounting Standards Board and GAAP, generally accepted accounting principle. Both of them recognize accrual accounting as the basis in which the company should record their transactions. Thirdly, it shows exact amount of profit and loss that is beared by the company. So it gives you an accurate picture of that. Next, we'll be talking about one of the three financial statements. So we'll start with balance sheet. We'll know the various components of a balance sheet, and also we'll have a sample balance sheet that I'll show you to have a deeper understanding of what balance sheet exactly is. So balance sheet contains the information about three primary objectives. That is, it tells us about the asset part of it. Asset means the future economic benefit that it would give. Second, it tells us about the liability section of it. Now, liabilities are what are the borrowings of the company, what it is liable to pay outside the organization, right? Thirdly, it tells us about the ownership of the company, the equity part of it. Okay, so the four major headers in a balance sheet that you will find are these things called current assets, current liabilities, non-current asset, non-current liabilities, and also the equity part. You will find it. Okay, so first we'll talk about current assets. Now, current assets are something that the company can convert into cash within a year. So these are also, current assets are also known as short-term assets because it is readily available within a year. Okay, so now balance sheet typically tells us its ability to repay any debts that it may have, right? So it just gives you a glance of it, how the company is doing, how much assets they have, how much liabilities they owe to someone, and what is the owner's equity in it. Okay, so the examples of current assets would be its short-term investments. That would be a very short-term based, short-term mutual fund, short-term, anything that would be converted into cash within a year. That would be a short-term investment. Second would be marketable securities. Now this would be a purchase of governmental things like government bonds, corporate bonds that can be cashed out within a year. Next would be amount receivable. Now this would be like the company has given out loans to other organizations or other business entities that would be repaid within a year with an interest on it. Okay, so this would also come under the current asset. Then it would be the in hand cash that the company would already have in its bank account, which it can use immediately during an emergency or during any other event. It has readily available. Next is the inventories that it possesses. So it can have a lot of work in progress inventories that are currently in use or being used in the coming months. So that would also come under current assets. So this was about current assets. Now we talk about current liabilities. Now these are the obligations that the company are due to pay someone within a year of operation. So in an year, what the company is liable to pay, it comes under current liabilities. So it would be accounts payable, short-term loans that it has taken from banks that it needs to repay within a year. The dividend. So if the company is very profitable, so that profit amount, it would share it with its stakeholders, internal stakeholders or general public, or the people who have bought its shares. So it would give out to them. So that would be dividends payable. Then it would be notes payable. Now the examples would include first accounts payable. Now accounts payable is an amount that is owed to a supplier of a company, of a primary supplier or vendor that it owes, right? That it needs to repay within a year. That would come under accounts payable. Second is dividends payable. Dividends is if the company is very profitable and it has an extra money that it wants to give back to its shareholders or the ones who have bought its share. So that would come under dividends payable. So this happens either quarterly or once in a year, so that it needs to pay out, or it can reinvest in its own company, but this is an extra amount that it gives out. Third is notes payable. Now this is the amount that it owes to a bank if the company has taken a short term loan that it needs to pay back, or to a financial institution, that comes under notes payable. Then comes accrual liabilities. Now these are short-term liabilities that the company has incurred. So it would be the interest on loans that it needs to pay back. It can be the tax that is liable to pay to the government, or it can be the salaries or the wages of employees that needs to be paid within 1 year. So these all things would come under current liabilities or short-term liabilities. Next would be non-current assets. Now non-current assets are also called as long-term assets or long-term investments that the company has made that is more than one accounting period, right? That would include the investment in government bonds, corporate bonds, mutual fund, and real estate that are in perspective of long-term arrangements. Okay, so these are not short terms. They would not withdraw the money in 1 year. It would probably be for like more than 1 year, for 5 years or 10 years, that the company thinks that this investment that they are making would give them hefty returns in the end. Second would be, now there comes two things in asset. One comes the tangible assets that you can physically touch, feel, experience it, right? So that would be property, plant, and equipments that you can physically see and that you would make use of it in the foreseeing future. Second would be intangible assets that you cannot touch with your hand or see it with your naked eye, but that exist. That would be patents, trademarks, intellectual property rights, and copyrights. So these would come under intangible assets. As non-current assets are, they are also long-term assets of the company. Next comes is non-current liabilities. Now these are also similarly, non-current means long-term, which are not due within 1 year. So all these bonds payable, long-term loans, deferred tax liabilities, long-term lease. So some of the times what happens is that a company takes a place for rent for like 5 years or 6 years in total. So the rents that needs to be paid out may be paid later depending on how the company's current situation is. So that would be a long-term lease that it would have to pay. Then it would be the deferred tax that it needs to pay to the government or regulatory bodies. Then it would be the long-term loans that it has taken for over a 20-year period or a 10-year period, something like that. Next is bonds payable. Now what happens is sometimes the company would ask loans from the banks that would be too huge for a bank to give out. So in that case, what happens is companies issue bonds to normal public or normal shareholders in which they guarantee a nominal interest rate on that particular amount. So for example, if someone is willing to buy the company's bond of let's say 50,000 rupees with a 7% interest, so this person would give the company 50,000 rupees, and in return they would give them a bond certificate stating that the company would be liable to pay him 50,000 rupees with 7% interest. Okay, so that interest part of it that needs to be paid is called bonds payable. Next, now we look at a sample balance sheet and know what are the components where they fit in. And to know where do you find all these financial statements, so if you go to the company's website, any company, it can be Tata, Mahindra, Reliance, Adani, anyone you can pick, you can go to their official website. So in that you'll scroll down, at the end of the page there will be a column called as investor relations. You click on that, then there will be options of reports. So in that there will be an annual report. So that is a very huge book. So it is a PDF of around 1000 pages. So in between of that, you will find all these financial statements there. So I'll show you how it looks like. So this is how a balance sheet totally looks like. Now it has three main columns. The first one is the header part of it, which tells us where the amount is received or going. Second is the note sections. So everything cannot be fit into this particular sheet. So there are some headers that has notes involved. So in the annual report, you can find the detailed description of each header there, where the money is and everything. So you'll find that in the note section here. So the next column would be this year's financial status of the company in 2021. So this is a 2020-2021 financial report. So in India, financial accounting period starts from 1st April to 31st March. So every year, 31st March is when this balance sheet comes out. So it gives us of a previous accounting cycle also, just to compare how the company has done in the previous accounting period. So this is how it gives an overview of it. Okay, so the first section is always the asset section of the balance sheet. So the first section is always the asset section of balance sheet. So you'll find assets on the top. So it is divided into two parts, non-current and current. We already discussed what that is. So as mentioned, we have property PPE, property plant equipment, other intangible assets, financial asset, loans it has given out, investments and other things mentioned over here, right? This is the non-current asset part of it. The current asset would be other trade receivables. This is the short-term ones. This is the long-term ones. Okay. So the total of these two, 1 and 2, the total of 1 and 2 would be mentioned over here. So this is the total assets. So the second part that comes is, so it has equity, share capital and other equity. The total of that is also mentioned here, 45,504 lakh rupees. Then comes the liability section of it. So liability is also divided into non-current and current liability. So that would be trade payables that we discussed, financial liabilities. So it has, depending on industry to industry, there are a lot of different types of headers. Okay, for an automobile industry, it would be different. For an airline industry, it would be different. For a petrochemical industry, it would be different. Or similarly, as garment industry, it would be different. So the headers would depend on sector to sector in which the company deals with. So now the subtotal of current liability is mentioned here, of non-current is mentioned here. Now we have previously discussed our accounting equation, which states that assets equal to liabilities plus equity. So the asset part of it, that is total assets 59,013 lakh rupees, should be equal to total liabilities plus equity. So this balance sheet has already done it for us. So total equity and liability, as we can see, is 59,013, which matches the total assets, which says that the balance sheet is already balanced and it is accurate. So the next financial statement that we are going to discuss is called the income statement. Now the income statement tells us about the revenues, expenses and the tax incurred by a company in a particular period of time, maybe a quarter or annually. Okay, so this is also known as profit and loss statement. So in a nutshell, it tells us about the profitability of a company. Okay, the main headers: revenue, expenses and EBITDA. From these three headers, we calculate a number of things like gross profit or net income or operating income. All these things are calculated using these three headers. So what is this EBITDA? Revenues we have discussed before, expenses also we have discussed before, but what is this EBITDA? EBITDA means earnings before interest, taxation, depreciation and amortization. So interest would be, I would be interest. So interest would be if the company has taken loans or something like that. So how much interest it to pay to the bank or from wherever the loan has been taken. Second is the taxes. So what are the taxes it has to give to the government, or the road tax that would be involved in logistical supplies. So all that thing comes under taxations. Then comes depreciation. So for example, if a company takes a truck and it is going to use for, let's say, 50 lakhs, and let's say that it is going to use it for the next 10 years. So after that, on the 10th year, let's say its value is only 10 lakhs. Okay, so in that 10 years, it has lost 40 lakhs of value, which is called as a depreciation. So the value that has decreased by the use of that asset is called depreciation. Next is amortization. Now, amortization means that paying off your debt in a regular repayments over a course of time, fixed repayments over a course of time, payments are called as amortization. Okay, so this thing would be in EBITDA. Now, income statements can be a lot more complex than it seems. So to understand it more easily, so I've broken down the income statement into several steps to make you understand more comfortably. So the first part of an income statement is, the first header is the revenue or the sales, right? So the total revenue that has been generated by the company through its operations. by selling of particular goods or service that the company is dealing with, and also the interest that it has gained by several investments or any other things that it might have gained money from. So that would be a total revenue. Now if you subtract COGS, what is this COGS? This is the cost of goods sold. So if you're making a particular thing, like if you're an automobile company, you're making cars. So what is the cost that you have incurred while building that particular car is called the cost of goods sold. So if you subtract that from revenue, you would get a term called gross profit. It would have a lot of different expenses involved, like let's say financial cost, employee cost, transport, logistic cost, etc. So all these things would come under operating expenses. Okay, so from that gross profit, if we subtract operating expenses from gross profit, we'll get EBITDA, that is earnings before interest, tax, depreciation, or amortization. Now in some instances there would be certain companies that would attach their depreciation and amortization in operating expenses. Okay, this would be technology companies, because technology companies do not have much of the products that have a depreciating value or amortization in general. Let's say that a technology company has several softwares, so it would not have a very big depreciation over the years, so they consider it under operating expenses. But other companies like oil, petrochemical, automobile companies, they have huge machinery which gets depreciated over the times, so that would be another section in income statement. But most of the technology companies keep it inside the operating expenses. Okay, so after subtracting this, you will get EBITDA. Now in EBITDA, if you subtract the depreciation and amortization value, you will get EBIT, earnings before interest and taxation. Okay, from that you subtract the interest part of it, then you will get your first thing, earnings before tax. Okay, so this is a major component when it comes to knowing how the company is performing, because tax would be almost the same over the years depending on the revenue and other factors, also government policies and everything. But main purpose to analyze a income statement would be earnings before tax, because it would give you a clear picture how the company is performing. If you subtract the tax part of it, then you will have your net income. Now this will tell us if the company is profitable or not. So this can be either profit or loss. Okay, so this was the major components, breakdown of components of an income statement. Now let's look at an actual income statement of a company. So this is how it looks. It looks similar to a balance sheet, but has different particulars involved. So it has main sections as revenue, expenses, and taxes, right? So similar to balance sheet, this also has three major sections. One is the current year in which the values are given for. The other is previous year to compare how much performance it has gained or lost over one financial year. Then would be the note sections. This would be an elaborate picture of what are the different particulars here. Elaborate picture would be in the note section. Okay, so let's see it. First is the revenue of operations, and the other income would be their investments or something like that, in which they have gained good amount of interest. Then revenue from operations is their core thing in which the company is standing there. So this is their USP, the way in which they make money. Okay, second part comes the expenses. Now this would include employee expenses, various financial costs, depreciation, and other expenses. So just as I said, some of the companies include depreciation and amortization in their expense part of it. So this company has done the same. So we can see, get the values of it. Now we get the total expense. After adding all these things, we get the total expense. That is 22,457 lakh rupees. So I would stress on this other expenses. Now everything cannot be put in an income statement. So you will find these other small minute expenses in the note sections. Okay, so 19th would be the note in the annual report where you would find this. Now we can see they have given us a good picture of profit or loss before their taxation. So this is earnings before tax. So if we subtract the revenue, total revenue, that is 26,855, to the total expenses, that is 22,457, we'll get earnings before tax of 4,398. Okay, so this part is earnings before tax, and we subtract other tax expenditures from it, then we'll get a net profit or loss, which they have calculated as 3,202 lakh rupees. So this is our net income. Okay, there can be several other things like mentioned over here, which depends on company to company and sector to sector. Okay, so we'll not go in depth on that note, but this would be your net profitability of the company. Okay, so how to differentiate between loss and profit in income statement? So as in this case, they have given loss in bracket. So anything that you see in bracket would be a negative value. Okay, so some companies directly give a negative value over here. Some of them give it in bracket. So it varies from company to company. Okay, so last section we see here is something called as earnings per equity share. Okay, so what does that mean? So this is called a financial ratio that we look for a particular company to compare it with other companies and to see the trends over the past years, how it is doing. So this we will know in a last module. We'll know it in detail what EPS means, earnings per share. So this was all about income statement. So the financial statement is called the cash flow statement. Now, cash flow statement tells us about the cash inflows and outflows from the company. So it gives us an idea how much cash does the company possess in hand at a particular time. So the main components of the cash flow statement or the main headers in a cash flow statement are three of them. The first one is cash flow from operational activities. The second is cash flow from investment activities. And the third is cash flow from financial activities. Now let's look at what does cash flow from operational activities mean. So cash flow from operational activities tells us about the cash that is spent or earned in the operations of that particular firm or business entity. So these particular operations are the core of what the company stands for. So its main product or service, how much cost that has been incurred, how much revenue it has gained. So it tells us about that. So this includes, as mentioned, revenue, working capital, how much amount is needed for its day-to-day operations. Then it's expenses. Now expenses would be rent, it would be the wages that it needs to pay to its employees, it would be electricity bills, and so on. So cash flow from operations is the addition of net income, the working capital changes, and non-cash components. Okay. Next is cash flow from investing activities. Now this would be the amount that is spent on other investments like mutual funds, land, property, equipment, acquisition and mergers with different businesses, and also investments in marketable securities that would be corporate bonds or government bonds, something like that. Next would be the cash flow from financing activities. Now, this would include raising and deploying for various financial activities like issuance and repayment of any debt or loans, as mentioned. Then it would be the payment of dividends, lease payments, issuance of equity. So, the major chunk of cash flow from financial activities for any business is generally either the repayment of loans or the repayment of debt or dividends. Okay, that constitutes the major chunk of portions in financing activities. Now let's look at a cash flow statement of a company. So as mentioned before, that it has primarily three types of cash flows. First is the A part, that is cash flow from operating activities. Now we have seen it in the income statement, that profit before tax. So it is the same value. Let's check. So in the income statement, we had this profit before tax on operations that was 59,387. Okay, so here we see that is the same amount in cash flow that has been carried forward from the income statement, 59,387. Now there are certain adjustments that are made. Now these adjustments, as you can see from here to here, all this would vary from company to company, sector to sector, it would vary. So now we won't get into this what it is, because it would have been different for an airline industry, for an FMCG company, for a motor company, and all these things would be different. So there are certain adjustments that need to be made, certain property, land, recoveries, logistics, losses or incomes that should have to be adjusted for. So that is mentioned in this section. So after adjusting, we have a net profit of 63,548. After that, the working capital that is required for the company, it also has certain adjustments in their inventories, trade practices, and all this financial assets. So these things are also adjusted. It can be plus or minus. So increase is mentioned in brackets. This is minus, decrease plus 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 plus, this is minus. After this we'll get a net amount of 61,759. now this is the cash that is generated from these operational activities. Now they would incur certain taxes on it, so after subtracting the taxes we will get a net amount of 47,405. So this was part A. So now the second part is the cash flow from investing activities. Now I already mentioned you what it is. So it is the loans that are released, the interest release, the payment, acquisition of land, property, and sale of any equipment if there is any. So these things are also added, subtracted in the way it is. Now total net cash from investing is this 7,472. So we'll add 7,472 to it. Now cash flow from financing activities is most of the times in negative, because these are the things that are rolled outside of the company, like dividends are paid to the company, the interest on the loans is paid back to the banks. So in this case all these things would be subtracted, so the net cash in financing activities would be negative. Okay, these all would be negative. Interest on liabilities, interest paid on lease, principal payment of liability, dividend and dividend tax paid. So all this is negative. So we have a negative figure. It's in brackets of 19,063. Now what should be in brackets and what not? That would depend. It would have some of the values could be positive and negative. You have to actually see which one is positive, which one is negative. So in this case, this financing activities is negative. So I'll add both of the A and B. From operational investing I'll add, and financing I'll subtract 19,063. Now I will get the net value that is mentioned over here, 35,814. Now what happens in this case is that it is rolled, there is a cash and cash equivalent at the beginning of every year. So that is basically the end of previous year's cash flow statement's last entry, that is cash equivalent. So as you can see here in 29, year ended in 2019, you had a cash equivalent of 52,590 lakh rupees. So this added with this year's cash equivalent, so this value here is posted here, because the end of previous year's cash flow entry would be this year's beginning cash flow entry. Okay, so this added with the net increase in cash flow would give us the equivalent for this year's end, 2020's end, and it would be marked as 2021's beginning. Okay, so these are the three things in cash flow statement that needs to be known: cash flow from operation, investing, and financing. So as common citizens, as retail investors, we would also like to put our hard-earned money into some of the best companies so that it can grow in the stock market. Okay, so in order to do that, we look at these financial statements that we discussed before. And apart from it, we also look at some of the financial ratios that are derived indirectly or directly from the financial statement itself. So let's to get a very good view on the performance of a particular company. So let's look at our first financial ratio called earnings per share. So earnings per share is the distribution of company's profit to the outstanding shares that it has allotted. Okay, so it tells us about the earnings of the company per share. So how it is calculated? So we got the net income from the income statement that we got, and the dividends that the company has given in a particular period, divided by the total number of shares that it has allotted. Okay, that is out in the market. Let's take an example. So example would be, let's say the company's net income, XYZ company's net income is 22 lakhs 15,000 rupees, and it has allotted 15,000 as dividend. Okay, and let's assume the total number of common shares would be 20,000. So if we calculate it, it would be 2 lakhs over 20,000. So that comes out to be, EPS comes out to be 10 rupees. Now what does it mean? So let's say that you as an investor has bought 200 shares of the company at, let's say, 500 rupees price. Okay, so if I multiply this 200 rupees with the EPS, it would give me 2000 rupees. Now this 2000 rupees is the company's earnings that has got because of you, that you have invested the money in. So now this 2000, what the company can do is it can give back to you as dividends, or it can put the money into its own company for its growth purposes. Okay. So when the company puts its money in the growth purposes, it is bound that the share of that particular company would go up because it's investing in itself to for a better future. So the share price will go up, hence the value of your shares will also grow up. So this is what EPS means. Next is, so now the PE ratio tells us about the profits to the earnings of a particular company. So it is basically how many times more I'm ready to pay for a particular stock than its earnings. So let me give you the same example that we had before. So in that case, our price per share was 500 rupees and our earnings per share was 10 rupees, right? So our PE ratio is 50. So basically, I am willing to pay 50 times more than its earnings. So now what is this value? So this PE ratio tells us about, is the company overvalued or undervalued? A very large PE ratio would mean that the company is overvalued. So it is probably the time in which you do not want to invest in such a company. While on the other side, if the PE ratio is very less, I mean in single digits or very less, then it means that the company is undervalued and it is a good time to open your position in these companies, start investing in these companies. This is generally what it means in a broader perspective, but again, it would vary from sector to sector, company to company. So this value, we can actually compare it with its peers. Okay, the peers would be different companies which are operating in the same spec sector. So we can compare different auto companies, different petrochemical companies. So you would have the choice to look at its PE ratio and choose which one would you like to invest in. Okay, so this is what PE ratio means. The next financial ratio is called return on equity. Now, return on equity tells us about how much money the company is making on its shareholders' equity. So basically, it tells us about how efficient is the company in making profits. Okay, so it is calculated by dividing the average shareholders' equity to the net income. Now, net income you will find it in the income statement, and average shareholders' equity you will find it in balance sheet. Okay, you'll find shareholders equity. How do we calculate average? So for a financial year, so you'll take an average of the first month and the last month, you will get average shareholders equity. Now let's take an example. Let's say a company is having a net profit of around 150 crores, let's say, and its average shareholders equity is around 700 crores. Now the return on equity would be around 0.21. So it would be around 21%. Now this is your ROE. Now for any company, in general saying it is that the ROE should be more than 15 to 16% is considered good. Okay. Below this is considered on the weaker side, but above this is good. But there is a catch. So return on equity is not the primary financial ratio to look at. It can be misleading at times. For example, if the company has taken debt, too much loans, then this ratio would become greater, which would lead to biased results, which would not be accurate in our analysis. Okay. So looking at ROE, first you need to look at its financials in detail. Does the company has a lot of borrowings or something like that? You need to check before analyzing purely on the basis of ROE. Next financial ratio is debt to equity ratio. So this tells us about the borrowings of a particular company. So how much the company is in debt per 1 rupee of shareholders equity. So the ratio can be calculated by dividing the total liabilities of the company. So debt to equity ratio can be calculated by dividing the total shareholders equity to the total liabilities of a company. Both the things you will find in the balance sheet, liabilities as well as shareholders equity. So on dividing it, you will get the debt to equity ratio. Now, if the debt to equity ratio is too high, it means that the company is in financial trouble. Okay, so it is not making enough revenue even to run its operations. So this can be a very risk factor if you are willing to invest in such a company with high debt to equity ratio.
Now let us quickly summarize the course and see what all we have learned in today's video. We started by learning about the basic terminology of accounting. Then we moved on to knowing about the various accounting concepts. Furthermore, we discussed about bookkeeping and its importance in accounting. And at the end, we learned about management accounting and financial accounting in detail. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoy this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions and I will respond to your comments.